starting to finally to emerge. We have been waiting for consumer spending to be hit by the erosion in purchasing power due to inflation. It seems to be finally happening. So a lot of the calibration, the pretty hawkish calibration of the Fed of the last 2-3 months was based on the fact that so far we had failed to see these self-stabilizing forces at play. If they are working now, well, there is a good case actually to revise the trajectory that you had in mind. It's not about breaking credibility. It's about being pragmatic about the state of the economy and what you want to achieve to deliver on your purpose, which is to tame inflation. If inflation is tamed in a way on its own, because people stop spending or spend less, normally that should make you think that you have less to do in terms of tightening. So my guess is that it's the current conversation going on at the FOMC, and it would be a healthy debate to have.
Jill, awesome to catch up. As always, Jill Mark there of AXA Investment Managers. A small technical connection problem there through that interview. Our apologies if that was disruptive for you. TK, what did Mark Twain say? History doesn't repeat itself, it often rhymes. 1970s, does it rhyme with the 70s? In the UK, the Unite Union, Royal Mail's 2,400 managers to strike between July 20th and 22nd. So that's the Postal Service, Tom, in the UK.
Scandinavian Airlines, I don't have the details in front of me, but we're getting very striky, John. And what concerns me is there's all sorts of articles that say it's not like the 70s. I get that. Labor's atomized, it's less union, particularly in America. But nevertheless, the tension's there to be disruptive. And I wonder how that folds across, John, to EM. I'm noticing India rupiah rather, out to new weakness moments ago. It's a jump condition. It's out over 2 standard deviations. And I think the linkage of, we're euro focused, but there's a lot more out there going on that's important.
Well, I can fold the strikes into what's happening with the euro focus, Tom, because it's Norway too. And Matt, as you know, the dependency on Russia has been a big deal, but that's going to shift towards Norway to some extent, to some degree. And what we're seeing is Norway and strikes there with the potential to cause even more pain in the energy market. And this goes back to energy and this relationship with the euro, and this is more than problematic.
Absolutely. And in Norway, seeing strikes like this is more concerning than the UK, where striking is a national pastime, right? The interesting comparison to the 70s, I think, and the pushback against it, a lot of it has to do with metrics, right? You talk to Neil Grossman, you talk to Bill Dudley, and they'll tell you, we measure inflation differently now, and if we did it the same, we might see 70s style inflation right now in the, where are we, in the 20s.
Do you think we grew up and they taught us how to strike, Matt? A national pastime in the UK.
There was a tube strike. I lived there for a few years. There was a tube strike every couple of weeks. It was just like part of the fun, right?
Do you know what used to happen when there was a tube strike? If you didn't grow up in London, but you'd lived in London for a long time, you only knew London, Tom, by the underground map. So what would happen when there was a tube strike is everyone would come up to the surface and they would have no clue how to get home. Did you see that take place, Matt? I would see that take place all the time.
I mean, I typically rode my Ducati to work after I realized that there was no way to rely on the tube. But other people, yes, had problems.
I remember
navigating.
Manus Cranny and myself, Tom, trying to navigate our way back from East London to West London without the tube and getting slightly lost.
It's a great story. I mean, I wish I had a beverage of my choice at 4 p.m. All I got this morning is a morning tang.
How was the morning tang?
I'm listening. The morning tang is good. Afterthought about some this weekend. She had a very tang 4th of July.
It tanged with vitamin C and enhanced tang. I saw that. Is that that's a real thing?
Enhanced is when you get the potato vodka.
I received that picture over the weekend.
The astronauts drank it.
Yes.
With vitamin C, and that's what people take it for now?
Yeah, the colonies. I mean, folks, we've got to remember.
I thought they stopped making this, Tom.
The weekend was about when the colonies won the war, 1781. It was a good and
that's what it was about.
Thing. Yes.
Okay. Thanks for info. I just thought it was an extra day off.
I'm sure you did.
Futures down 0.5% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A 22-year-old man is being held in the deadly shooting at a 4th of July parade in Highland Park, Illinois. He was arrested following a brief police chase. Authorities say gunmen opened fire from the rooftop of a building near the parade route. 6 people were killed, a dozen more were wounded. President Biden marked the 4th of July holiday by noting the U.S. has made great strides, but has also taken a few steps backwards. At a White House event, the president said Americans are worried about division within the country. He also described the economy as growing, but not without pain. Turkey has renewed its threat to keep Sweden and Finland out of NATO. The Turkish foreign minister says Turkey will not ratify membership in the alliance for the 2 countries if they don't fulfill their promises to extradite terror suspects. The Turkish parliament will eventually vote on Sweden and Finland's NATO applications. And the UK will force owners of apps such as social media and search engines to curb state-linked disinformation. If they don't, they face fines of as much as 10% of annual global sales. The crackdown is part of the forthcoming online safety bill. And Bloomberg's learned that a consortium led by KKR is emerging as the front-runner to buy a stake in Deutsche Telekom's wireless tower portfolio. The business could be valued at around $20 billion. In any deal, Deutsche Telekom may pick a winner this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
look, Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think the message was crystal clear from this week's remarks by central bankers. They worried about inflation getting entrenched, rightly so. So I think the notion that the Fed will blink early this time based on credit issues is not likely to happen.
Mohamed El Arian, absolutely brilliant on Friday off the back of what's happening with credit. Spreads are wider. 580 almost on high yield spreads on Friday at the close. That's the story with credit for equities right now, down 0.5% on the S&P, on the Nasdaq 100 down 0.6%. Right. On Euro Dollar Watch, Tom, 103 just about, trying to hold on to that level. Citi coming out with this, Vasilios Giannakis just publishing moments ago, saying two reasons: risk sentiment one, natural gas the other, and concluding we now think the probability of euro dollar falling to parity in the near term is around 80%, unless nat gas manages to stage a strong reversal to the downside. It is very difficult to see pressure abating for now.
Amy, give me the chart if you can, the EU chart of nat gas. Let's look at this very quickly here, John. This is very different than what we see in America. It's real simple. Out of the Netherlands, a big surge up. And, John, critically above the moving average I used for the February spike.
Unreal, Tom, and that's where the pain is. And here's the problem, Tom. Do you think we've seen the peak of the pain?
No.
When it comes to gas?
No.
And that's the problem the Euro's got.
The calendar, you run an algebraic equation, folks, and you got to put the calendar into it. Someone who's very, very good at this is Amrita Sen. She was absolutely brilliant the last time she was on with us, and we lean forward now with the gentlelady from Energy Aspects. Open question, Amrita, with all that's going on. What is a significant paragraph in the note you're going to write this week? What's the thing that you're really studying right now?
Two things I'd say, Tom. First and foremost is around recession. I do think while there's a lot of fears around exactly how the recession is going to pan out, what it means for oil demand, for us, the critical thing to highlight is that Asia, and I know you and I have talked about this a lot of times, China's reopening. I really do think recession, or at least a mild one, is actually priced in. If you look at December 23 Brent futures, we're at $90. Nobody's talking about what if demand holds up a little bit better. What could prices then do? So we are looking into that. And then, of course, on the supply side, we've got the strikes going on in Norway, the Libyan outages. But, we've got some seasonal pressure coming through as well.
Are the responsivenesses, or the fancy word elasticities, of natural gas the same as oil? Is the elasticity of Netherlands nat gas like Brent crude?
So I would say on the industrial side, well, let's start with the consumer side. On the consumer side, absolutely not, right? Because from a consumer point of view, natural gas is electricity, which basically means that you are absolutely going to require it, particularly for home heating during the winter. Whereas arguably you could drive less unless and until you have to drive to work, right? So from a consumer standpoint, elasticity for gas it's even more inelastic than oil. Industry, however, we have already seen, if you look at Germany, Netherlands that you talk about, they are dialing down a lot of the gas consumption simply because gas prices are so high. Our models already build in some significant demand destruction in Europe because of high gas prices. And the risks to gas prices are actually to the upside, given what went on with Freeport in the US, lower LNG from there. If Chinese demand picks up in the winter, you could see even less LNG come through to Europe from the Middle East as well. So again, risks, just like you guys were talking about, is absolutely to the upside when it comes to TTF prices in Europe.
I will, Tom, I will see your elasticity and raise you a fungibility. Why aren't natural gas prices why isn't natural gas as fungible as oil, Amrita? We see such a huge difference in the price here versus the price in the Netherlands. Why aren't they as interchangeable?
Oh, absolutely. Great question, actually. It's just for the simple reason that oil has always been a more global commodity. Remember when the US used to not be able to export crude, we had WTI trade at $20 discounts to Brent, right? That's when it wasn't as fungible. Now with exports allowed, again, ultimately the price will dictate flows, whereas gas is slowly getting there. It's been more regional markets. And even right now, the US doesn't export as much gas as probably it could do at these current prices. And then, of course, you've had the outages at Freeport. So that's the big problem and the difference in gas. It's always been more localized markets, Middle East supplying Asia, Russia supplying Europe, and kind of US, its own little market, US and Canada.
I want to ask also about the competing calls on oil this morning, Amrita. Citi, of course, $65, which makes sense if we have a deep global recession. On the other hand, JP Morgan is saying it could go as high as 380, which is, you know, an eye-grabbing headline. But what Natasha Kaneva puts behind that, I think, is even more interesting. She says, this is the JP Morgan analyst, that given Moscow's robust fiscal position, they can afford to weaponize oil and just pull 5 million barrels a day off of the global market. Do you think that's realistic?
We actually don't think that's likely because so far we still see Russia acting as a rational player in the market, both for oil and for gas. It doesn't mean that energy doesn't get weaponized. I mean, particularly in the winter, more so for gas than oil. We could see that. But definitely not our base case. But I think in both cases, what I will highlight is that these are very eye-grabbing numbers precisely because, you know, you guys are talking about it. It makes the media headlines. I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment. Look at the US at $120, $110 WTI. The Dallas Fed survey, all it talked about was labor shortages, equipment shortages, and steel costs. Nobody's actually able to raise production very much. So that's on the one side. If Russia were to actually cut 5 million barrels, but it doesn't even have to do 5, it could do just 2 or 3, given how tight the market is, you can literally pick a number. I mean, 380, it could be 4 something, it could be 2 something.
Well,
I mean,
Amrita, just to jump in, because
a
we only have like
territory
20
that we've never been before.
So forgive me. Could the global economy tolerate anything with a 3 handle once you get to 200,
no, absolutely
300?
Not. We would. No, absolutely not. I mean, then the only reaction has to be a very, very deep recession, and oil demand has to collapse by 5 to 8 million barrels per day to even balance this market.
Amrita Sen, thank you, just for clarifying that. Of energy aspects, Amrita Sen there, just on what's happening with the commodity market. That's your floor, maybe 80 for the likes of Amrita, Matt, and once you go above 200, most of these guys in this market, these analysts, just do not expect this economy to tolerate that for very long at all.
No, the economy couldn't tolerate it for very long, but the market may be able to do it. I mean, remember when we went negative?
Sure, no, I agree with you.
Yeah.
There's a price.
Yeah, the price action is, I mean, if you see real tinkering with the supply, then the price action, the sky's the limit, basically.
Looking ahead to payrolls this Friday, this from Citi just moments ago, Tom. They're expected to slow down to 290. They're on your page. A clear slowdown, sure, but well above long-term trend growth and clearly above recessionary levels.
I mean, that's the game we're going to have into Friday. And we don't have an ADP report this week, right? Am I right?
We have to wait for that, Tom, for a while, I'm told.
No, it's frankly better. I'm not.
You're not disappointed?
Honest. No,
you're not alone.
It confuses.
From New York, this is Bloomberg.
that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We've been looking for not necessarily a technical recession, but a significant enough slowdown into next year.
I do think the second half of the year will be much better than the first.
The underlying fundamentals are still pretty good.
The next 6 weeks, in my opinion, the news headline battle is going to be between earnings and inflation.
Overall, we're looking at an economy losing momentum faster than what we anticipated.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Together this morning with Matt Miller. Bramo is out of the building. She'll be back next week. Your market, not much change here. We're down another 0.4% on the S&P. And Tom, the downgrades are piling up.
The downgrades are piling up. John, we're all going to die. Out moments ago, the research piece of the long weekend, always the bull, John Stolfus of OPCO. And I'm sorry, John Farrow, it's real clear. Mr. Stolfus says, consider the second half of the gloom of 1970. We went from minus 24% to plus 33%. He says the gloom is way overdone. Look at history for lessons.
Okay, but would you acknowledge that his optimism has been way overdone as well?
I would say that we're in a bear market, and anybody bullish, whether it's John Golub or
Tommy's at 53.30 year end on the S&P.
Well, okay, he hasn't adjusted yet. Maybe he'll adjust down. I'm just saying the gloom this weekend, John, it was stunning.
Catch down seems to be the story right now, because it's been Goldman, Tom, Morgan
Stanley, yes, that's the right
Mike Ferretti
phrase.
over at JP Morgan. They're all revising their growth outlooks lower.
Well, they're revising it, and Matt Miller had a very important point. First one this year, and John, Matt Miller said, is it about the economics of the moment, or is it about the financial markets of the moment? And are they on the same page is an important question into Friday's jobs report.
Matt Miller, which one is it?
I think right now it's really about the economics. I've been watching closely ever since reading the notes last night, the Atlanta Fed GDP Now survey, and it shows that we're in a recession technically. Now, I was talking to Gary Schilling about this weekend, and he said, we're not in a recession until the NEBR says we're in a recession. But clearly, if we have 2 quarters of contraction back to back, this economy isn't as strong as a lot of the optimists think.
That's when you get to call it a technical recession. To Gary's point, you need to see a breakdown in the labour market, something more broader, Tom. And we're not seeing that. And this is what Citi say. And I understand that the labour market's the backward-looking tool. I get all of that. But this is the point that Citi are trying to make this morning. And I think they're on your page, Tom. 290 is their estimate for Friday in payrolls. That is a clear deceleration. That is a clear slowdown in jobs growth. They go on to say, though, but also well above trend, well above long-term trend growth, and clearly above recessionary levels. Is this just a battle of semantics, TK? Does it matter? You're cool.
I don't think it's about. I don't agree that it's semantics. I think there's some very important analysis going on here. And just as one idea not discussed right now is the partition of the domestic economy dynamic, and there's some real gloom there, versus the complete uncertainty of the international dynamic as well. My answer is, you look at the mood, and the mood now is as gloomy as you can be. Do you have the courage to step in amid this gloom? And that's the point of debate that we're in this week.
That's the Marko Kolanovic view over at JP Morgan. His view, Matt, is that things are so depressing right now, the average investor is so negative that it's a low bar going into earnings season. Jonathan Golub of Credit Suisse is on the same page, and they think, Jonathan Golub, for instance, at Credit Suisse thinks that we can get double-digit gains in the back half. Marko Kolanovic over at JP Morgan thinks that we can recover the first half losses in the second half in some parts of this market. There are some optimists out there, and I think that plays against some of their own views, which is that everyone's bearish, because on the south side, Matt, I can find some constructive people.
I do not think it's a low bar going into earnings season. If you look at the analyst estimates, and we were talking about this with some individual stocks, and we were talking about this with, strategists like Stoltzfus. They still haven't revised down their forecast. They still haven't revised down their expectations, and that needs to come. You have a problem when you don't listen to Cassandra, right? Cassandra was gifted with a vision of the future, but cursed by the fact that no one would listen to her. And Michael Burry on Twitter, his handle is Cassandra, points out valuations came down in the first half. Margins are coming down in the second.
Is Cassandra with BNP Paribas? Have we booked her?
We've booked her. She's joining us a little bit later this morning.
I just was hoping so.
You won't listen to her, though.
Abramowitz would never be quoting Greek mythology. I mean, I'm sorry.
Tom, Mike Wilson over at Morgan Stanley was super diplomatic on this point on companies and earnings. Our experience is that the higher quality companies will admit the problems earlier. And that's what they're looking for from the high quality companies this earnings season. Futures right now, negative 0.4% on the S&P. On the NASDAQ 100, down 0.5%. And here it is. We have got to talk about this. If you're just tuning in worldwide on TV and radio, we've got a 102 handle on euro dollar, 102.97, Tom. We're down 1.2%.
Yeah, to steal 20 seconds here, John, how do I look at this? I go to the Bloomberg and I triangulate to see what's moving, and without question, it's an ugly euro morning. And then I go over, John, and I look at the great trade-weighted currency statistics of IMF and some of the major banks, Westpac, Deutsche Bank, Morgan Stanley.
Connection lost.
And the answer is trade-weighted might not be as grim as some of these pairs, but boy, are they moving in a challenging direction.
I'm a simple man. I just get the chart up and wait to see how long I have to take it back since the last time we saw it here, and it was 2002.
You got to do more than that. You got to extrapolate out, which I did, Plaza Core, DXY, and the answer is, that's what you got to. I know we got to get to David.
This was a lovely chat, Tom, and then someone just jumped in my ear and shouted "guest" really abruptly, and just ruined the mood of the morning.
It's Cassandra's in the control room.
David Riley joins us now, Chief Investment Strategist at Blue Bay Asset Management. David, I want to go straight to high yield. The additional compensation that some of these riskier companies have to offer this market over the risk-free asset, and that's getting wider, bigger, pushing 600 basis points in and around 580 right now. David, when does that become a problem for this Fed? Mike Schumacher of Wells last week said it was a feature, not a bug. When does it become a bug and not a feature?
I think when we get to something like sort of 800 on US high yield, at the moment, we're not really seeing that much kind of, dysfunction or distress within the high yield market. Primary supply has been crushed, but most of the companies kind of termed out. They have pretty low refinancing requirements, and the distress ratio, so bonds trading wide of 1,000 basis points is about 10% of the market. It's as you said, I mean, the Fed wanted tighter financial conditions. That meant wider credit spreads, higher rates, lower equities. That's what it's getting. And I don't think at the moment that's enough to kind of make the Fed blink.
David, you are known for great acuity on asset allocation and decision making. What is cash right now? Is it something to avoid? Is cash something where you sit in it as an emptiness, or is it actually an interest-bearing object?
Look, cash is an asset, and I think it's an asset which offers, fair amount of option value for investors at this point in time. So, we are running above sort of typical cash balances across a lot of our strategies. Obviously, inflation is eroding the real value of that. So we want to be deploying that on behalf of our investors. And at the moment, the places where I think there's some value would be in, to be honest, to go up in quality, and I know others have said this, up in quality and improve the liquidity of your portfolios. And I think investment grade credit is actually starting to look pretty interesting. Break-evens are pretty wide. We've seen a meaningful repricing across investment grade. And if we do go into recession, you've got a little bit of cushion coming from any rally you might get in duration.
Are we in a recession now, David?
It feels like we're in a recession. I think Europe is going into recession. I think the UK is in recession, and I think it's an open debate in terms of the US. And obviously, the payrolls report on Friday will be interesting, as will be the FOMC minutes later this week.
David, we used to have this old cliche in the market: you can stop panicking when policymakers start to panic. Does that hold true anymore, David? What does that mean this time around in this market regime?
Yeah, I think what has fundamentally changed in the market regime, and I think we're all kind of struggling as market participants and investors to adjust to it, is that in the sort of pre-pandemic lowflation era, any kind of growth scare or growth issues, we knew the central banks would come in and provide support. But they're not in that position to do so now, because inflation is just far too high, and they're worried about their credibility. They're worried about second round effect. So I think the danger is, if you like, is that policymakers, leave it too late to panic, and we actually, by being backward-looking, end up, raising rates too far, and ultimately push the economy into recession. And I think if the Fed goes meaningfully above 4% in the Fed funds rate, we're going to get a recession. And people debate whether it's going to be a deep recession or not. I mean, who knows? But I wouldn't like to be too aggressively positioned going into that kind of environment.
David Raleigh of Blue Bay Asset Management, the new consensus, a shallow recession. That's how quickly this consensus has moved. We've gone from hardly any hikes this year to no recession to recession, but a shallow recession.
Long and shallow.
Long and shallow. I thought it was short and shallow. Is that the consensus? Whatever. There's a lot going on this morning, including US and China talks about removing tariffs. And we understand, according to the Washington Post, that Secretary Blinken could be meeting a Chinese counterpart at the G20 this week. That's one story. Here's another. Matt Miller, what do you make of this? The German cabinet approving a bill to enable energy company bailouts. If that doesn't speak to the energy mess in Europe right now, what else does?
Yeah, absolutely. And you heard Robert Habeck, the Green leader, saying that energy could be Germany's Lehman Brothers moment, right? They're going to do maybe a $9 billion bailout of Uniper, the natural gas company, or the subsidiary of the Scandinavian natural gas company, and they're going to pass more of the costs along to consumers. That's going to be a real problem, because German inflation looks like it's turned over a little. If you look at the chart, it's come down a little, but it's going to go right back up with that.
I did the walk of the newsroom in the morning and dropped by Tom's desk to see what's on the Bloomberg. And Tom, what's there pretty much every morning for you? European nat gas.
Well, we're looking at European nat gas is the big distinction here, but the biggest thing, folks, is to see John come through the newsroom in the morning and walk through my entourage. He's got to get past like 8 people.
Are you admitting you have a bigger entourage than me now?
Well, that's part of my agreement. Yes.
Confirmed.
I have to always have 2 more people than you.
You just have 4 tenths at 1%.
4 less than Abramowitz.
Is that in your contract?
Yeah,
I bet it is.
I have to have 4 less than Abramowitz.
The NASDAQ, that's 6 tenths of 1%. Bramo is out. We miss her. But Matt Miller's filling in. We love that. Until next
Is
week.
she on the Amalfi Coast too?
She's not,
Why?
Tom.
Is there
Crete,
something-
I'm told. Crete.
Oh, Crete.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Highland Park, Illinois, a 22-year-old man is being held in connection with the killing of 6 people at a 4th of July parade. Dozens of others were wounded. The man was arrested after a brief chase. Police believe the attacker opened fire from the rooftop of a building near the parade route. China and the U.S. have discussed Trump-era tariffs that President Biden is looking to ease. Vice Premier Liu He told Treasury Secretary Janet Yellen that the lifting of tariffs and sanctions is an area of concern. There are reports that the president may announce a rollback of some tariffs on hundreds of billions of dollars worth of Chinese goods. That will help lower the costs of everyday merchandise. And the euro sank to a 20-year low against the US dollar today. Investors are betting on the prospect of a less aggressive hiking cycle by the European Central Bank. The euro fell below $1.03. It is down more than 9% against the dollar this year. And British Airways is scrapping more flights from its summer schedule. Like a lot of carriers, BA wants to end last-minute cancellations caused in part by staff shortages. British Airways has now reduced its timetable by 11% through October. The UK government has waived rules that require airlines to use takeoff and landing slots or lose them the next season. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So softwares come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This week, all eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Wednesday, July 6th, right here on Bloomberg.
Overall, we're looking at an economy losing momentum faster than what we anticipated. So right now we have a recession call for beginning the first half of next year, but I think if anything, the data shows that timing looks like it could be even sooner.
That's the sound of an economist who's about to downgrade their outlook for economic growth.
Is.
I mean, that's my interpretation, yours too, Tom. That was Sarah House of Wells Fargo's senior economist from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, together with Matt Miller. Bramo is back next week. Futures negative 0.6% on the S&P. On the Nasdaq 100 down 0.75%. Euro dollar, do we have to get used to this? Sub 103, 102.90, negative 1.26%. And Jordan Rochester of Nomura, Tom, confirmed to join us in about 20 minutes' time.
Yeah, thrilled his saxophonist will be with us. It's going to be great to talk to him. John, is there a bid here? And the answer is no. I haven't seen a bottom.
No, and there are two reasons for it. Sentiment, investor sentiment, one, this according to Citi, and Nat Gas, two. And Tom, unless you can see a turnaround in the latter, there's problems ahead for Europe.
We wrote up the script. We could do this with Joseph Matthew, of course, holding court on radio with an incredibly important conversation, sound on, and he joins us here in a far too early morning for him. Joe Matthew, if this was President Trump, he would be out on Fox morning talk shows screaming about a stronger dollar. Not the politics of it, but the fact is the former president was upset about the ramifications of a stronger dollar. What's the dollar policy of President Biden?
Well, I think it comes through the end of the policy on inflation. That's the conversation that we're having first. And when I say that, I mean consumer prices specifically here, which is why we're back talking about something else that Donald Trump spent a lot of time on Twitter about, and that is tariffs and trade with China. This is apparently going to be unfolding in the next couple of days. You know, we have to get to this story, look at where it began. The tariffs against China were implemented in a series of rounds. The first couple of rounds were about industrial equipment. They were about transportation. Then things like consumer goods were added after the fact. So if you find, you know, the president lifting tariffs on things like bicycles and sunscreen, some reports suggest that he could actually increase tariffs on some of the other. How that impacts inflation and the dollar in the end is unclear, although from what we've heard from some very smart people, Peterson Institute, Barclays, they suggest that it would be muted, 2 to 0.3% decline in the rate of inflation.
And Joe, there are really two international issues that we're focused on this month in terms of the Biden administration. One is the tariff talks that you've explained so well this morning. The other is the trip to the Middle East and Mohammed bin Salman to ask for more oil production. What's the likelihood that we really get something out of that?
Well, did you hear the president when he was in Europe asked about this, and he said, no, I am not specifically asking Saudi Arabia to increase production, but all of the parties who will be there, which sounds a little bit like tamping down expectations ahead of what's going to be an incredibly important trip, asking the Saudis and others to open the spigot here. But, you know, when you back off and look at this, you'll find just as many skeptics about that idea as you do about the tariff idea. All of these are kind of biting around the edges to try to fight this inflation problem, just like the release from the SPR, like so many other things that this White House has done to try to build a wall here. And we can keep putting bricks in this wall, but not everyone sees the actual result being what they want.
I mean, Joe, as you know, Nikki Haley, and I don't want to get into it right now, did some inflation mathematics this weekend, which went viral on Twitter. They did, folks, I'm not going to go into it, but they completely screwed up the mathematics. The mathematics, Joe, of your view of the administration is these are all teensy-weensy little things. What can he do substantial to get away from teensy-weensy additive changes?
If I had the answer to that, I'd probably be working for him right now. Because
well, maybe you will be, because, you know, when's the shift come up? It's a sweaty, hot July. Matt Miller says everything's fungible. Is the staff of the White House fungible right now?
Maybe the staff of the White House will be fungible after November. But no, look, I don't think this is a White House that has that silver bullet that you're asking for as much as Joe Biden wants it. It is about nibbling around the edges. The hope, though, is that you can create a composite effect with these smaller moves to actually have a meaningful impact on inflation. The fact of the matter is Bloomberg has some very smart people when it comes to economics. You are some of them, and you know that if we start talking about an economic pullback or an actual recession here, that may be the only thing close to a silver bullet.
Hey, Joe, great to catch up, as always, down in D.C. Joe Matthew there. Do not miss Sound On a little bit later on Bloomberg Radio. Weekdays, of course, at 5 p.m. Eastern. We need to talk about this FX market. That is a break of 120 on cable, sterling 119.93, euro dollar earlier this morning with a break of 103 at 102.90-ish. There you go, Tom. Euro dollar, a breakdown. Sterling, a breakdown.
Well, yeah, and you know, I don't know which one's a bigger deal here. I would suggest that most of the people we talk to, John, are watching sterling as separate, discrete, and something that could really cause some social angst within the United Kingdom. I think it's an important point, John. If you have weak yen, do the Japanese people care? If you have weak sterling, do the British people care? If you have weak euro, do the people really care? And I think that's a point of study this week.
If you're importing inflation right now, you care.
The Germans care a lot about weak euro.
In what way do they do that, Matt? Color that, please.
I would just say that the Germans follow exchange rates much more closely than the Brits or the Americans, as far as I can tell, and especially, Tom, with the trade deficit story that you've pointed out, they're going to be looking much more closely.
I didn't point that out. Farrell pointed that out. I was asleep.
Look, front and center is an energy problem. So if you're an energy importer and you've got a weaker currency, you've got a big problem, haven't you? Let's make this really, really simple. And that's why a lot of this becomes a bit of a vicious cycle.
Okay.
And you wonder how it breaks, Tom.
And you guys have lived the calendar. To the both of you, when does the change in temperature and seasons click in on the continental energy story?
Well, that's one for Miller, since he lived in Germany and I left Europe a long time ago, Matt.
Well, I will say that deep into September, you can have temperatures higher than 30 and even up to 40 in Berlin. That's Celsius. I'm not sure what the Fahrenheit
Thank you, Matt.
exchange rate is.
You've gone so Euro, you're only thinking in Laquai and Celsius?
It's not till the end of September that you really get a cooling.
There we go.
In
That's
Germany.
all I wanted
That's
to
for
know.
Germany. I do remember it in England, Tom, that the weather, you never know. It could be July or August when the cold starts to kick in.
You know, I'm learning here. I talked to one of Abramowitz's entourage. John, she's like top ticking you. I mean, I can't keep up. My goal is to go below 52nd Street this summer. You know, and, you know, maybe get down to Ruby's at Coney Island. She's in Crete somewhere.
Yeah. That's the annual trip to Crete.
Where's Crete? It's in the Mediterranean, right?
That's right, Tom, over by Greece. It's a Greek island.
And she's like some holistic Epicurean, you know, everything's fresh kind of restaurant.
Is that right? Are you naming the restaurant that she's at right now?
No, I don't want to do that.
Is that the zip code?
I would never want
to. If you put the zip code on TV for where Bramo
you know,
is
if
right
you
now.
want to send a postcard.
You don't respect anyone's privacy, Tom.
John, it's big. It's the zip code for the entire island.
That's the entire island. How big's the island? I'm sure they can find her.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Coming off the back of a week of losses, and we add to them this Tuesday morning. Good morning to you all. We're negative about 20 points on the S&P and down 0.5%. On the Nasdaq 100, down 82, with negative 0.7%. We've talked about the downgrades building for the economic outlook from JP Morgan to Morgan Stanley. Take your pick to Goldman Sachs, all of them for the outlook. Chop, chop, chop. Citi remains somewhat constructive. Citi believe this Fed will keep on hiking. This Friday, they look for 290 on payrolls. The consensus 273, down from 390. A slowdown, yes, but for Citi, they point out that that is not a recession. Not recessionary levels for them in this labour market. And some of you might scream back, yet. Let's talk about the bond market. The bond market has been responding to weaker growth, that's for sure. On Friday, an ISM manufacturing with a new orders component in contraction territory. We haven't seen that since May 2020. In your bond market, it was yields lower, yields lower, yields lower, yields lower for 4 straight days. We opened back up this morning with yields just a little bit higher, Tom, up by 3 basis points on the day.
As I mentioned earlier, John, the distinction to me here is we had shifts in the curve last week, and this week we've got dynamics in the curves. That's the big change.
Reversing some of the moves we saw last week. And Tom, you might have a look at the difference between 2s and 10s. That difference just a couple of basis points right now. That curve is getting flatter again this morning.
And there's a big distinction between flat and an inversion, John. That's not a small item to pros.
Right now, Tom, that distinction is just 2 or 3 basis points. Yeah. That's the bond market. Here's foreign exchange. Euro dollar, a break of 103. 102. A break of 103, and you've got to go back 2 decades for the last time we saw this in 2002. 102.87, and I go back to the worker city, Tom. 2 points they're making this morning. Risk sentiment is one. The second one is nat gas. And if you don't believe that nat gas starts to turn the other way in Europe, then get used to the look of this chart right here and those numbers.
That's the politics, but let's frame a 1.03. Euro came at a 1.16 a million years ago, and there was that whole weak euro bit, John, down to what, 0.85, 0.89? So we're in between the span, if you will, of euro.
115 is the high of the year so far, I believe. Very close to those levels. So that is a big move lower. Big move. Jordan Rochester of Nomura is going to catch up with us a little bit later this morning. 15 minutes away. Do not miss that conversation. For a while now, he's been waiting for this one to head towards parity. That's your cross-asset price action. Let's get you some single names. I'm pleased to say we can do that this morning with Kriti Gupta. Morning, Kriti.
Well, good morning, John. Let's talk about that FX story, because as we see that euro-dollar drop and weaken and weaken and weaken, that dollar strength is what's really crucial here. You mentioned natural gas prices. We'll take a look at this. It's showing up right here in the U.S. stock market with those oil names, that class of inflation hedge that's been working fairly well this year to date. It's working this morning as well. Occidental, Exxon, Devon Energy, all higher on the day. And those names that have more exposure to American production, like Occidental, actually outperforming the likes of ExxonMobil, which is a little bit more diversified. But once again, it's that oil story in the face of stronger dollar that continues to be key. Let's stick with the stronger dollar story, though, because as you see, it has ripple effects across not just the oil and the commodity names, but other names, other multinational companies that has that exposure to abroad. And names like Nike, Starbucks, Microsoft, the common thread here is that all of their businesses have this massive exposure to China, to Europe, bringing back those profits into the state, turning them into dollars. That's going to have an effect on the bottom line. And staring in the face of the greenback, you can see already right off the bat this morning, they're already weaker this morning, Tom.
Critty, thank you so much. Greatly appreciated. Right now, we reframe into the second half of 2022 with Mark Cabana, head of U.S. rate strategy at B of A. He takes in Ethan Harris and the team on economics and folds it right over into the fixed income space. Mark, I'm going to go short right now. LIBOR is lifting. I'm sorry, I'm old school enough where I still care about 3-month LIBOR. Up, up, up we go, the moonshot. What is the significance of the short-term trust market showing higher yields?
Well, it could mean two things. One, it could mean tighter Fed policy, or two, it could mean a broader tightening of financial conditions and worsening of credit. We think it's more the latter right now. We think it's just the Fed policy that's kicking in, causing overall front-end rates to increase. And that's going to have a tightening of financial conditions, especially if you're a floating rate borrower. This is what the Fed is trying to achieve. They're trying to slow the economy down. They're trying to tighten financial conditions and borrowing rates, and LIBOR is a reflection of that.
What is your fixed floating analysis now? A coupon that is fixed and the dynamics of that versus a floaty coupon like John Farrell's more used to because it is a floaty Great Britain?
Yeah, well, look, if you're an investor, you want to be in a floating rate instrument, and if you're a borrower, you want to be in fixed. It's a dynamic where the front end of the curve is rising. We do think that the curve will invert 2s, 10s. We think that you're probably going to see the funds rate inverted to the 5 and the 10-year point in the not too distant future. And again, that's to be expected with what the Fed is trying to do in order to slow the economy and ultimately try and get inflation under control.
So, Mark, let's reset. Let's think about where you think this Fed funds is heading, because some people have questioned that and actually brought their expectations in, not pushed them out. Where are you now?
Yeah, so the B of A house view is that the terminal Fed funds rate will be at 4 to 4.25% in the first half of next year. We think that the Fed will get to 3.5% by the end of this year and then keep going in the first half of next. Now, that's naturally going to be dependent upon the economic outlook. But as you were discussing earlier, look, we think that the economy will slow, but with the labor market this tight, we're somewhat skeptical that we're in for an immediate recession. We're well above the break-even rate in jobs growth that'll be required in order to see the unemployment rate sustainably increase. And our team is a bit above consensus. We're at 325 for the end of this week. And I do think that with the labor market that's strong, some of these discussions of an imminent recession will have to get pushed out because you really need to see the labor market slow, we think, before a recession will be nigh.
But with the terminal rate that high, Mark, wouldn't financial conditions be way too tight? Again, I spoke with Gary Schilling over the weekend, and he reacted with shock and horror when I suggested that the Fed would go to 4.25%.
Yeah, well, again, it really depends upon how resilient the underlying economy will be. We're not looking for an imminent recession. We are looking for a notable slowdown, but not an imminent recession. And we do think that the economy will be able to withstand higher overall interest rates. Now, we're not seeing that in the market today. The market has taken down the extent of Fed hikes quite meaningfully. It's priced in cuts really starting in the middle of next year and then continuing through 2024. But again, we're not there yet. And we do think that you need to see more of a labor market slowdown in order to necessarily guarantee that the Fed is going to be changing course.
How far out? How far out do you think spreads are going to go, Mark? What should we be looking for there?
Yeah, well, we think that the financial conditions broadly have to continue tightening. That is what the Fed wants to see. They're already seeing some response from tighter financial conditions in terms of things slowing. And I'm not a credit spread analyst or expert here, but we think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation lower and for the Fed to feel like they can declare victory in that backdrop. So we're still cautious on the risk backdrop.
Mark, Michael Rosenberg and the team at Bloomberg a decade ago invented the Bloomberg Financial Conditions Index. It was picked up by the IMF within 14 days as a key barometer for them. It is now sitting at a negative 1.2 standard deviations. At what point do financial conditions have to tighten to where it changes the dialogue or the belief set, the construct of our central bank? There's got to be a tip point where they change because the facts change.
Yeah, we get asked a lot where the Fed put is, and in terms of how far down from the peak in the equity market do we need to be? We don't think we're there yet. We've long argued that it's probably going to be 30% down, but it could be close to 40% down. But I don't think that that's what a central bank necessarily cares about. They don't care about how far have equities fallen or how much wider have credit spreads gotten. What they care about is what happens in terms of the reaction function for businesses and consumers. When do they really start to dial back? When do businesses say, we don't need that next bit of CapEx, or we don't want to hire that person? When do consumers say, I don't need to buy that next car or take that next vacation? That's the response function that they're looking for. And we're starting to see some signs of that already. But we think that there's still a fair amount that that needs to happen in order to see that dialing back in activity. And again, it's going to look like a pretty notable slowdown or a recession. But we don't think that we're quite there yet. We'll probably get there, we think, by the fourth quarter of this year or early into next year.
Mark, isn't that the horses bolted indicator? Isn't that just really late when you start to wait for that kind of stuff, evidence of it?
Well, that's what they need to see. They need to be convinced the consumer and businesses are going to be dialing back. And look, we've seen sentiment indicators that have been very, very low for really the balance of this year. And you haven't seen that response function yet. And so, again, if you were going to be looking at forward-looking indicators or sentiment, you would have already thought that we're in a recession.
Sure.
Maybe we are, probably not, especially with the labor market that is this strong. And so what a central bank needs to see is they need to see that dialing back of activity. And look, central banks typically overshoot, right? They either ease too much or tighten too much. That's probably what the Fed is going to be doing in this cycle, but they need to be convinced that they're seeing that adequate slowdown. And thus far, we're not convinced that they have.
Mark, that was a clinic. It's great to catch up, sir, as always. Mark Urbano there of Bank of America Global Research. Tom, take your pick for a headline. A four-handle on Fed funds. We're only halfway through the tightening of financial conditions. And ultimately, the concluding remarks there. What matters to this Fed? You probably won't find it in this market. You'll find it somewhere else.
My tone on what we heard from Mr. Cabana was go out the x-axis, and I think this is really important. Right now, the financial media, and Stolfus mentions this in his optimistic note today, there's a complete focus on the short term. John, I'll let you define what the short term is. The answer is if you go out 1 year, 2 years, 3 years, you've got to change because things get washed out. Things move on. Corporations adapt. Where are we in our analysis? Can we even go out a year right now, John? How many people are brave enough?
You're touching on the heart of the issue, and you touched on it earlier.
I did
it's the
okay.
difference between the economy and the market. You've got a more constructive view on the economy and working our way through this. But when you listen to Mark there, Mark's making the point that I agree with you, Tom. I'm more constructive on the economy too, and for that reason, Fed funds needs to go higher. And for that reason, financial conditions need to tighten more.
Martin Feldstein, 101. All drops on strong dollar are stochastic. You go down, the facts change, you come back. That's the history.
Tom Keene, Matt Miller, Jonathan Ferro, Bramo out of the building. We're in Crete, apparently. The Bramo family is in Crete. Futures are negative. She'll be happy, Tom. 102.97 on euro dollar. That vacation's getting cheaper by the day. Euro dollar negative 1.2%.
Fragrant herbs,
You read the menu.
aromatic spices.
It's a menu.
It's a vibrant seasonal dish.
What's the restaurant called?
Nathan's.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A 22-year-old man is being held in the deadly shooting at a 4th of July parade in Highland Park, Illinois. He was arrested following a brief police chase. Authorities say a gunman opened fire from the rooftop of a building near the parade route. 6 people were killed, dozens more were wounded. President Biden marked the 4th of July holiday by noting the U.S. has made great strides, but has also taken a few steps backwards. At a White House event, the president said Americans are worried about divisions within the country. He also described the economy as growing, but not without pain. The UK will force owners of apps such as social media and search engines to curb state-linked disinformation. If they don't, they face fines of as much as 10% of annual global sales. The crackdown is part of the forthcoming online safety bill. And semiconductor stocks are trading at bargain prices, but investors are still staying away. Chips are the worst. S&P 500 group this year down some 38%. Micron Technology gave a disappointing forecast, whilst Intel said the macroeconomic environment is weakening. Research firm Gartner expects PC shipments to fall some 9.5% this year. And people in China have largely escaped the consumer inflation afflicting other major economies, but that may be about to change. The government has embarked on a campaign to rein in the market for pork. Hog futures are at their strongest in a year, whilst wholesale meat prices are at a 6-month high. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
one risk I'm really worried about is liquidity risk. And we're starting to see markets locked out of funding. And keep a very close eye. Issuance in June was very low. Companies either were unwilling or unable to refinance themselves.
That was Mohammed Al-Aaron of Queen's College, Cambridge, the president and, of course, Bloomberg Opinion columnist from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, together with Matt Miller. Lisa out of the building on vacation. She'll be back with us next week. Futures negative 0.7 on the S&P 500. Your main event, it is in foreign exchange. Euro dollar 102.98. The lows of the session 102.81. Sterling against the US dollar, so-called cable 120. The low of the session 119.89. Some big breakdowns in some big currency pairs worldwide this morning, Tom.
Let's get to it right now with Jordan at Rochester. It's not that he's been alone, but he's been way articulate about the case for weaker euro. Jordan Rochester is with Nomura. He's been with us often. We get an update this morning. Jordan, I mentioned earlier the great Martin Feldstein of Harvard, who noticed that when you get weak euro like 1985 or 2001, you get a stochastic response. It goes down, it's weak, and it turns around. Does this have the same feeling that when we find euro weak bottom, we'll turn around and come right back?
Tom, you're kind of on the money there about the non-linearity of the euro moves. This morning, I can explain why it's moved, but it's been non-linear. It's been much faster than folks expected. And a lot of people who are looking to the normal macro drivers, the sort of ECB headlines, to suggest why it could go lower, they didn't have that. It was Norwegian gas flows. We can come back to that. But in answer to your question, I don't think euro is a buy at all, Tom. I think we go towards parity. I think we could even break parity. And the moves will be non-linear when we do that, because it will be because of gas supplies being cut off, perhaps with Nord Stream 1. And I think as we get to these levels, we've broken key levels all the way back to the French elections and so forth. Periods of very strong euro weakness. We've broken those. We're in a no man's land now, all the way down to parity.
If we are non-linear, does that suggest that Mr. Putin can drive euro lower?
He already is. And I think, yes, he can do more. So to give you some more color on why I keep mentioning gas, the move today is because German electricity prices, go onto your terminal, type in Germany electricity 1 year, the record highs for the 1 year part of the curve. So it's not a temporary story anymore. German consumers will be paying record prices, whoever's buying at these levels, for the next year. And that's going to affect consumers' contracts. So that's a consumption squeeze for European consumers. That's recession risks. Recession risks push euro lower. Norwegian workers have gone on strike. So 13% of Norwegian gas supplies are turning off this week. And we've looked into it. If someone can let me know, but we don't see an end date to those strikes until their demands are met.
That strike
so we
escalation,
have a big uncertainty on those.
Jordan, this headline just crossed on the Bloomberg that it could shut 56% of gas exports on further escalation. That's a problem. So can you tell me to what extent your call on euro dollar, and you are looking for parity, I know that, and have been for a while, to what extent is that call basically a call on European gas prices?
It's a little bit like that. That's been the primary driver of the volatility, especially today. But there's a few other factors as well that feed into the euro view. It's not just about gas prices. Global recession risks. We're looking for a US recession in Q4 of this year. Euro does not strengthen when we have recessions, especially with the peripheral yield risks that we have in Italy and Spain and elsewhere. So there's recession risks driven by the global phenomenon of what's going on. Europe's main trading partner is China. China's going through what we call a COVID business cycle, and we've just had another wave of COVID-19 cases, some more lockdowns announced just over the past 24, 48 hours. So the exports for Germany are being weighed on by gas prices, making German manufacturing less competitive, 7 times more expensive. That's how much gas prices, electricity prices are in Germany versus America. So American exports more competitive, and Europe's main trading partner, China, is in a state of slowdown dealing with lockdowns.
Jordan, you have a lot of the same problems in your island nation there that people on the continent of Europe have. Plus, you've got Brexit seemingly flaring up again, right, with the Johnson government throwing out agreements that they made just a year ago. How much worse can it be for the pound?
Well, we are short sterling, looking for 118 in cable, and I think with the non-linear moves I just described, in euro-dollar, cable could go below that as well. So that the direction is lower. It's just a question of how much lower. And in terms of the lists of reasons, the Bank of England's less hawkish than other central banks. That's making US yields less attractive to foreign investors. The UK's trade surplus doesn't exist. It's a deficit, and it's getting wider. So the UK is facing similar problems to Europe, but a key difference is the UK has Brexit, of course, and I'll come on to that. But the UK raised taxes. National insurance taxes went up. The energy subsidies that Boris Johnson's government announced didn't really cover everybody. It did a good amount for the lower half of society, but for the middle classes and higher, didn't do much. So you're going to see a consumption squeeze. But yes, let's bring it to Brexit. I think markets are looking at the Northern Ireland Protocol noise, but I don't think sterling actually has a premium for the potential for an FTA to be suspended. Now, I don't think we will see the Northern Ireland Protocol situation lead to the EU issuing sanctions or issuing anything like that in terms of tariffs or quotas. So that's why the market is ignoring it, because I agree with the market there. But if it was to happen, who knows what can happen in these markets, then sterling would be even lower than 118. So we're looking at 110 towards parity in that scenario. That's why I don't think it's going to happen. That is just a nuclear button for the politics.
Some big calls there. Jordan, thank you, buddy. As always, Jordan Rochester there of Nomura out of the City of London. Matt Miller, here's a headline for you from the German Economy Minister, Robert Habeck, not ruling out intervening in gas prices. That just
How do you do that?
From
Wow.
Germany.
Wow.
I'd love to know. But essentially, that is the statement that has just been made. Matt, your thoughts?
Well, and it's also the opposite of what we've been reading over the past couple of days, right? With the bailout of Uniper and the law change that just went through the Bundestag, we expected them to allow higher costs to be passed through to the consumer. So I'm not sure exactly how Habeck would intervene. And the interesting thing that doesn't really matter is that this goes contrary to his party's raison d'etre, right?
Oh, there you go with the French.
So, well, I'm just saying they want to reduce the use of fossil fuels, so higher prices should be good for the Greens,
Well,
right?
There's been one hell of a reality check about how you go about doing that. That's for sure over the last 12 months. TK, have you got a Netflix call in the mix as well? Going into earnings.
We're getting into earnings season here, and they're adjusting. Tom Champion over at Piper Sandler, great shop on Netflix. He goes a little weak. And he does it, and he just says, look, it's the new streaming. Paul Sweeney is expert on this with me in radio on the 9 a.m. And the answer is streaming wars are here, John, and they ain't happening. This show, Stranger Things, which I ran into this weekend, it's going to happen, but it's not going to save Netflix, according to Piper Sandler. They go to I believe, a neutral on Piper Sandler.
What about time?
John, this weekend I'm talking to Afterthought. She's glued to this.
What's she watching?
She wants a name change. She wants me to call her 12 from now on. I said,
12.
what is 12? And it's like a character, and I don't know. They're in Hawkins, Indiana.
That's straight over my
I got to
head,
get.
but
I mean,
no
I
idea
got to
what
get
you're
up to
talking
speed.
Can I just remind you how dreadful the price action has been over the last two earnings reports for Netflix?
Yeah.
Down 35%.
I've never got it. I've never, full disclosure.
Down 22%.
Where's the profit?
Brutal. Futures down 0.8% from New York City this morning. Good morning to you all. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, Udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame. Sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
If anything, the Fed hikes yet more than what you already have priced in the market.
Given the fact that volatility is so high and liquidity is so low, we are a bit cautious.
I think the rest of the year, we're going to see decelerating inflation growth.
The level of demand destruction that's actually coming through is accelerating.
The consumer is on somewhat more fragile footing, so we're seeing cracks emerge in their spending patterns.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Tuesday, a holiday-shortened week. Well, here we are, Jobs Day on Friday. Matt Miller in for Bramo. She's off. And John, all I got to say is foreign exchange is the litmus paper of the global system.
At TK, we've had a break of 103 on euro dollar, a break of 120 on cable, back to 135 on dollar yen. Front and center, Tom, dollar strength. And fueling that dollar strength, the energy move we're seeing in Europe, shaping a view that we get a recession there, and fueling that dollar strength clearly is risk sentiment off the back of some downgrades, Tom, to global growth.
Yeah, the downgrades really get my attention, John, because there's a story here, and there's a Norway angle, and this angle, and that angle. But the real angle here is uncertainty into the second half of 2022.
Without a doubt, and we have downgraded the outlook for this economy in the United States of America, whether it's Goldman Sachs, whether it's JP Morgan, whether it's Morgan Stanley. They've all done that. Chop, chop, chop. Tom, it's earnings next, and that's going to be the big driver for many people of this equity market.
Piper Sandler out on Netflix today, and maybe that's not that germane. They've got their own soap opera as well. But what a difference of opinion, John, do we have on the earnings view forward? Ben Laidler, more optimistic than many.
Yeah, more constructive. Throw Golub into the mix over at Credit Suisse. Throw Kalanovic into the mix over at JP Morgan.
Stolfus at OPCO.
Morgan Stanley and Mike Wilson have got different views on this, Tom.
Right.
They think the warnings are still in our future, and we haven't had them all yet.
Matt Miller, let's use your expertise here on Germany today, truly world class. And the answer is, in Germany, they're not worried about earnings expectations. They're worried about paying the gas bill come September.
Yeah, paying the gas bill as those prices continue to exponentially rise.
That's the right word, yeah.
I think they're also worried about selling their stuff, right? Even with a weaker euro, and we hit 102 handle today, we saw car sales come down in France, portending a bigger drop across Europe, and it's difficult because they just can't get them off the lot without the chips they need.
John Fair, we've been ECB free today. What does this mean for Christine Lagarde? You covered Frankfurt for years. Her degrees of freedom are much more limited than Jerome Powell's.
Bundesbank pain, that's new. That's new. Not new in the last 10, 20 years, but for this president, she hasn't had to deal with a whole lot of it. She might have to now. The Bundesbank, in a speech in the last 24 hours, Tom, pushing back against the prospect of building this fragmentation tool, whatever that looks like. I think that's going to be a thorn in their side as they try and put something together. And how do they thread this needle at the ECB? I have no idea, Tom. How do you tighten financial conditions but not too much? And what is too much?
Yeah, what is
too much in Italy compared to, say, Germany? This is going to be a difficult one.
Well, I'm going to start the data check here. I'll go to FX here and say that the blended BBDXY index, the Bloomberg Dollar Index, is doing a little better than the major trading DXY through a 106 on DXY, John, is really something. And yen hasn't played 136.04.
To see 102 on a chart before today, you've got to go all the way back to 2002. 102.90 on euro dollar, negative 1.27%. Yields just a little bit higher on a 10-year at 288. That was not the story last week. Yields lower for 4 straight sessions, Tuesday through Friday, off the back of weak data. Just starting to see the front end lift up 4 basis points on a 2-year to 287. So your curve, the difference between 2s and 10s, a single basis point. And the inversion that some of you are looking for, Mark Cabana over at Bank of America on this program 15, 20 minutes ago, he's looking still for a 4 handle on Fed funds. He thinks, Tom, this economy is strong enough to get Fed funds through 4%. For this Fed to be able to contain inflation. That's the work that he thinks they need to do. The pushback we've had on that call, Tom, already in the last 20 minutes, massive, because people are basically coming out and saying, okay, take it to 4. Does that do anything about energy? Does that do anything about food prices? Well, I can tell you from the demand side when it comes to energy, maybe, but Tom, as you've said a million times, you've got to eat. You've got to eat, and that is not a joke. That's the problem you've got right now, Tom. Things are expensive, but there are some things you have to carry on buying.
Well, there's no substitute for them. And, of course, Matt Miller with the word for the day, fungibility there. Wheat isn't fungible in Cairo, in Egypt. This is a joy because over a decade ago, Sam Stovall did what is hard to do. He followed on from his truly historic father and wrote the 7 Rules of Wall Street. It did rather well. Mr. Stovall is with CFRA. Sam Stovall, what is the rule of Wall Street this morning?
Well, good morning, Tom. I guess the rule of Wall Street is you don't fight the Fed. And I think that the Fed does have to remain aggressive because this is now the 6th time since World War II that we have had the year-on-year change in CPI above 6.5%. And every prior time we slipped into both a bear market and a recession. So I think there are still concerns ahead.
Sam, help me with the earnings picture as we kick things off next week with JP Morgan. What are you looking for, and to what extent is the bar low? We've got the optimists saying the bar's really low, earnings are going to be fine. We've got others who said we haven't even started cutting our estimates on that front.
Well, my father used to say that you could rarely injure yourself by falling out of a basement window. But I don't really think that the expectations are that low just yet. Yes, they've come down. On March 31st of this year, we expected to see the S&P post a 6.3% year-on-year rise in Q2. Now it's at 5%. And profit margins, which were expected to be down 4.1%, now expected to be off 5.3%, with more and more sectors joining on the negative side. So I still think that there is more downward revisions to be experienced.
Yeah, I mean, we're talking about Netflix today, Sam. Piper Sandler just reducing their call to a neutral from a buy. But, you know, John was talking about the price at 179. I see that the analyst estimates are still for 283. So they still expect a 60% gain between now and the second quarter of 2023. When will analysts bring their revisions down?
Well, in many ways, I think it's once they hear from management in the coming reporting period that not only will we end up seeing earnings come in weaker than anticipated for this quarter, but then they will be forced to reduce their estimates. In many ways, we find, prices lead fundamentals, and right now, fundamentals are holding firm, but I think like Wile E. Coyote, they're going to look down soon and realize they don't have the support that they were expecting.
Sam, can I ask you a trivial question? In your time at the Stern School of Business or learning portfolio construction for the CFP, the term drawdown to me always meant peak to trough, and you've got to fully recover before you can measure a drawdown. It seems that it's the word of the quarter this year. Everyone's using it to replace losses. Doesn't drawdown have to be measured after a full recovery?
Yes, just the way we decide whether we are in a pullback, a correction, a bear market, and whether the bear market is a garden variety or a mega meltdown. You have to wait until the trough is in, for corrections and pullbacks, we got to get back to break even before we can say that that's what we were in. And for bear markets, we need to see that 20% advance off of the prior bear market low. So you're right. A lot of this is done in the rear view mirror. And maybe the term drawdown implies that, well, maybe you didn't sell out and actually turn a paper loss into an actual loss. So they're doing a little bit of refining on the terminology.
Sam, awesome to get your view on things going into earnings season, kicking off next week. Sam Stovall there of CFRA. Matt, you remember the Netflix numbers? A lot of that was just an industry view, wasn't it? We were never talking really about the weakness in the economy. Those two surprises, those negative surprises from Netflix, I'm just going through those numbers. 20th of January, stock down 22% off the back of earnings. A weak guide down 35% on April 19th. And here we go again, Miller. For Netflix, we're down 70% year to date. Just goes to show how much work we have done in some parts of this equity market already. A tremendous amount for some of those names in the NASDAQ.
And the concern on Netflix is that you've reached some level of saturation already as they switch over to more of an advertising supported model. But remember how well we did during the lockdown because there was nothing else to do. Well, it's been suggested that if we have a deep enough recession and we all lose our jobs, we'll go back to doing nothing else but watching Netflix at home.
I remember when the economy got smashed and my dad cut the cord on Sky Sports. And of course, it wasn't cutting the cord back then. It was the satellite dish on the side of the house. You think about how many subscriptions you've got to choose from, Matt, with the flexibility month on month to make that cut. Tom, you and I have talked about this a million times. It's not just about making the choice to cut Sky Sports or the satellite package. You've got individual choices, $10 here, $15 there. You can start to see some of that emerging, Tom.
Yeah, and Matt Miller talked about fungibility, which means substitution. And, we make jokes about it because we're supposed to make jokes early in the morning. It's not funny, John. I mean, people, particularly a middle class clobbered by inflation, are going to make choices that will go over to entertainment. They're going to go see the new Top Gun like you did. I know, John, you've seen it 5 times. But, the answer is they're going to make choices here. And on the revolution is streaming. It's simple. Paul Sweeney says they're going to get down to three in the house.
I actually went on Sunday, Tom, to watch it for the first time. And can I just say, what an upside surprise, to use some market terminology.
Yeah.
What an awesome movie.
There we go, your movie review.
Matt, I was so impressed.
Well, you know my problem with it.
What was your problem?
Where's Charlie, right? The whole point of the first Top Gun is, he's going to leave, he's all down and out, but he comes back for this love of his life, Kelly McGillis, and they don't even mention her. All of a sudden, Penny Benjamin is the only one left.
That was some weakness in the story plot. You know what the other one was for me? That they had a generation of fighter jets that they didn't have.
The F-35 wasn't there,
The enemy, Iran, had a superior jet, and I couldn't get my head around that either. And why did they choose the F-18?
I think they used the F-22 because they could put 2 people in it, and the actors weren't allowed to actually pilot the jets. So the actors sat in the back seat or the front seat. I'm not sure which one is. But the F-35, they had some reason that they made up for why they couldn't use it against the Sukhoi 57s, which were awesome.
You know more about this than I do, clearly.
Just to indicate here, folks, the planet that we're not on, I've not seen either movie. And this weekend,
you haven't seen the original?
No. And this weekend, Mrs. Keene said, let's watch Grace Kelly. So we did with William Holden, Bridget Tokari. And she wants the bag that Grace Kelly had in the movie made in 1954. How
much is that?
I don't know. Grace Kelly, I have no idea.
It would
Too
be
much.
cheaper for you to watch
Grace
Top Gun,
Kelly,
Tom.
No, Grace Kelly just killed it with William Holden.
That's what you did over the weekend.
That's what I did over the weekend.
Hot dogs with ketchup and not mustard. Apparently.
No, I did not have ketchup. Afterthought I had ketchup.
Another leg lower on this equity market. We're down more than 1% on the S&P. Yields turned lower too. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Highland Park, Illinois, a 22-year-old man is being held in connection with the killing of 6 people at a 4th of July parade. Dozens of others were wounded. The man was arrested after a brief chase. Police believe the attacker opened fire from the rooftop of a building near the parade route. China and the US have discussed Trump-era tariffs that President Biden is looking to ease. Vice Premier Li Hu told Treasury Secretary Janet Yellen that the lifting of tariffs and sanctions is an area of concern. There are reports that the president may announce a rollback of some tariffs on hundreds of billions of dollars worth of Chinese goods. That would help lower the costs of everyday merchandise. Global news 24 hours a day on air on a Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. and it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This week, all eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Wednesday, July 6th, right here on Bloomberg.
Don't think that it's highly likely that they go to 4% in Fed funds rate. We do think that'll be, a little bit too much of a catalyst to the economy. But right now, the market is really corrected with a 3.35 March peak and then almost 60 basis points of easing in the second half. We still think the Fed will most likely do 75 in July.
Leslie Falconio there of UBS from New York City this morning. Good morning. Tom Keene, Matt Miller, Jonathan Ferro, Bramo is back with us next week. A well-earned vacation for her. Then she goes away again the week after that, Tom. Futures down by 1% on the S&P. It's a leg lower here on the Nasdaq 100. We're down by 1.3. A lot of talk about the FX market. Euro dollar with a 102 handle, 102.89.
Yeah, drifting down again.
Negative 1.28%. We have some problems with gas. You know that story. This euro is weaker. This dollar a whole lot stronger. Yields lower again for a fifth straight session, down almost a basis point to 287.29. And here come the downgrades. Jonathan Golub of Credit Suisse was at 4,900 on the S&P for 2022. He goes down to 4,300. He's reiterating his outlook for earnings. That's still constructive, Tom. He says the target is being adjusted lower to reflect the higher cost of capital and valuations. It is not about recessionary concerns. Jonathan Golub of Credit Suisse, Tom, earlier today.
We're going to see a lot of that in the second half of this year. John, I would suggest everyone needs to recalibrate at 8:31 a.m. this Friday.
Well, Tom, you mentioned last week we'd see the downgrades, and here they are.
Well, they are, but John, are they going to recalibrate again off a jobs report that, to our previous guest, suggests a fully employed or fairly fully employed economy?
If you need to recalibrate again, Tom, it will come off the back of the earnings because the data's already weaker.
Or off of your pink slip as you go out the door.
Well, I'm not laughing at that, Tom, because that's not funny.
Right now for radio, this is important. James Bianco is always informed at Bianco Research in Chicago, and he joins us this morning, and he is ensconced with a button on his lapel. And no, it's not some little American flag button. It is a big old whip inflation now button. Jim Bianco, that was from another time and place. The red button, the white letters, Gerald Ford, Greenspan rolled over is the advisor to Ford and said this will never work. And they said no immediate miracles. Turn the button upside down. What is the immediate miracle that Joe Biden needs right now to fix inflation?
Well, I think it is that inflation is the issue. Look, the debate right now in the marketplace is slowing growth and high inflation. And the market seems to want to center on the idea that growth is slowing, so we got to cut our idea on how aggressive the Fed is going to be, lower interest rates, because the economy is slowing. I don't think that matters as much. I think that the priority now is whip inflation now, is to bring inflation down. So if the economy wants to weaken, it weakens. As long as prices stay up, I think you're going to see an aggressive Fed, and you're probably going to see higher interest rates and an inverted curve. And to this Friday's payroll report, I've been watching the show this morning. If we do get 250, 300, 325,000 jobs, bad news is, good news is bad news. That just means the Fed could go 75 and can talk about another 75 right after that for the September meeting.
Jim, the hallmark of your work is you look at the glide path, as Peter Orszag would say over at Lazard. And if I suggest a glide path that's nonlinear, there's got to be a kink somewhere on inflation. Let's say we get to 5%. And that's the kink where it becomes different. What's the strategy of the Fed now versus the strategy of the Fed at that kink where they got to get down to the new 2%?
Well, if they were to get to 5%, then I think you'd probably see the Fed readjust. But the June numbers expected, the Bloomberg estimate is another 1%. That means that through June, we'll already have 5% inflation done for the year in the first 6 months. If you look at the numbers from last year, we had 0.4, 0.3s last summer. We could see an 8 handle on inflation well into the fall. And if we do see an 8 handle on inflation, and Chairman Powell has made this abundantly clear, he's not backing off if we don't see the inflation numbers come down.
Well, and he can't afford to now.
You could argue there.
Jim, I mean, he can't afford to now, right? They have to go 75 on July 27th, because if they don't and inflation pops higher, they risk looking like Arthur Burns.
Exactly, and I think that they've set the stone. They set this in stone, and that's why it's been so difficult for the market to come around to this idea that slowing growth is actually going to matter. And by the way, GDP is out the next day, July 28th, and the Atlanta Fed number at minus 2.1. We're within 30 days of the meeting. It is never beaten by 2.1. So you'd almost have to expect they're going to go 75 basis points, and the next day we're going to get a second consecutive negative GDP print, and we've never had 2 negative GDP prints that were not in a recession. So this could be very difficult for the Fed that week, that they hike 75 the same week we have a recession.
This is a point that bears repeating, Jim, and I picked up on it by following you on Twitter. The Atlanta Fed Now GDP forecast, I'll just say it again, is for a contraction of 2.1% in the second quarter, after we know the, I think, 1.5, 1.6% contraction in Q1. It's terribly unlikely that they're wrong, right? At least in terms of up or down.
Yeah, I mean, they could be wrong, but are they wrong by more than 2.1%? They've never been that wrong this close to the meeting. Now, there's always a first time for something, but history says that we probably are going to print a second negative GDP number the day after the Fed probably hikes 75 basis points.
And they'll have to hike again, and maybe again. Jim, what a world we live in right now, sir. Jim Bianco there of Bianco Research. We're getting some really interesting calls on the south side. This from Nomura moments ago. Jordan Rochester didn't share this one with us, Tom, 30 minutes ago, did he? And he published just now.
Let's explain that. Legally, he can't do that, folks. He's got to sell it to his clients before he sells it to John Farrow.
And here he is publishing. Today's move lower in euro-dollar, thanks to Norway's gas strikes, new highs in German electricity prices, is just a warning sign as to what might materialize. He goes on to say, we have an even higher conviction that euro-dollar will breach parity towards 98 in August, and maybe, Tom, even lower.
So how do you have a higher conviction on a war in Ukraine, Mr. Putin, Mr. Zelensky, and the rest, with all the seriousness of that, with what Folkert's Landau says, at some point they must address strong dollar. A 98 euro is something. That's 0.98, folks.
Within that, Tom, is a call on gas prices. And Matt, I think this is where the FX teams are getting a bit uncomfortable, because they've got to make a commodity call. They've got to make a gas price call in Europe to ultimately make that call on euro-dollar.
Yeah, the connection made by Jordan on this program I thought was fascinating. I just want to point out as well that we talk about the euro at the lowest since 2002. That's when the euro really started. You can talk about 85, you can talk about 2001, but we didn't trade our Deutschmarks for euros until January 1st of 2002, and it was about 90 cents at the time.
Matt Miller, Tom Keene, Jonathan Ferro, futures negative 1% on the S&P from New York City this morning. Good morning. Heard on radio, seen on TV. This is Bloomberg Surveillance.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Looking ahead to Payrolls Friday, live from New York City this morning. Good morning with Tom Keane and Matt Miller. I'm Jonathan Ferro. Bramo is going to be back with us next week. She gets a well-earned rest. Futures are down more than 1% on the S&P, just off session lows on the Nasdaq 100, down by 1.2. We've talked a lot about the FX market breaking down on the euro side. Dollar strength just breaking out. Euro dollar 102.96 and down 1.22%. Some really interesting calls out there. Nomura, they get even more bearish on the euro. They're looking for maybe 95, base case 98. That's the downside into August for them. And then into the bond market, 4 straight sessions. Treasuries firmer yield to lower, make it 5. We're down 3 or 4 basis points to 284.18. And it's a core government bond rally, Tom. Go to Germany. We're down 12 basis points on the front end in Germany today, Tom. Down 12 basis points on a 2-year, down about 10 on a 10-year.
And I would emphasize, John, a lot of this has happened in the last hour off of different headlines, some from Germany, some not. The equity market, it's down, but it's not down to where it was June 30 or July 1. The Dow, 331 points. The VIX really hasn't come out yet, John. A VIX over 30 would get my attention.
Just to recap the adjustment over at Credit Suisse, Jonathan Goldberg's been pretty constructive for the back half of this year. He mentioned to me only last week that we could see a double-digit gain. That's not the call anymore. 4,300 is the base case. 4,900 was the case previously. That's a big cut. Making the point that this is not recessionary concerns for the team at Credit Suisse. But, Tom, the cost of capital is going in the other direction big time.
Well, the cost of capital will be at both nominal and real, and that is a good place to start with John Riding, his chief economic advisor at Breen Capital, has been of assistance to us for many, many a year. And, John, I think the question right now on cost of capital is now, do businesses, do they think in the nominal space, or is everybody a slave to the inflation-adjusted analysis?
Well, Tom, if you think about it, we haven't had these kind of inflation problems since the late 70s, early 1980s. So many businesses are simply not used to handling an inflationary environment. And money illusion exists amongst consumers, and money illusion exists amongst businesses as well. I mean, if you look at the policy rate, so start with the policy rate, with a CPI inflation rate of 8.6%, you're still looking at a policy rate that is extremely negative in real terms. So all the anxiety about the Fed raising interest rates, it has to be looked at in the context of that inflation rate. And businesses,
Okay, well,
I think, the idea that we've had this bear market in equities, but it's been a multiple adjustment to a higher nominal yield. It hasn't so far been an earnings adjustment.
And I think of you and Michael Darda on this, and this is with your work at the Bank of England at the Fed years ago. So many people haven't lived this. And what I'm hearing from relative optimists, we will adjust as yields move higher. We will adjust as Powell, Lagarde, and the rest bring up interest rates like New Zealand this morning. Do you have that optimism that we'll adjust along the way?
Well, there will be adjustments along the way. And to the issue, and sorry to take issue with Matt, for example, 2 negative quarters of GDP, if we have them, don't make a recession. A recession is inevitable, but I don't think that it's imminent. And as companies, I don't think companies experienced a recession or negative GDP in the first quarter. If you look at the income side of the accounts, a second equally valid measure of GDP expanded by 1.8%. And if you look at business surveys and you look at household surveys, people are negative about the economy because they're trying to handle this inflation problem, but they're relatively positive about their own financial prospects. Companies are relatively positive, small businesses are relatively positive about their own outlook. So there's this disconnect because people are trying to adjust to that inflation problem, and they haven't experienced doing it. But research shows, contrary to what the Fed has tried to do, that households do not like inflation. Businesses do not like inflation.
Yeah.
I'm worried. And ever since Lloyd Blankfein told me to get my house in order, I've been freaking out about this. But I want to ask a couple of more Eurocentric questions, John. I asked Tom a couple weeks ago if a weaker currency is better or worse in terms of inflation. How is Germany experiencing this in real time right now? As we see a euro go down to 102, the inflation picture had rolled over there. Is it on the way down, or can it pop back up?
Well, we have to remember that when it comes to using currencies to judge inflation, currencies are a relative judgment. It's a relative judgment about the Federal Reserve versus the ECB. And it is quite clear that the Federal Reserve is much more aggressive and planning to be more aggressive in hiking rates than the ECB. So the currency reflects that relative judgment, but the US has had a strengthening dollar and is suffering just as bad an inflation problem as is being experienced in core Europe. Certain parts of Europe, Latvia, for example, was referred to in Powell's hearings. Inflation north of 16%, inflation in Spain, 10%. Those are way above the 2% rate that the ECB is... which has one objective. The ECB doesn't have a dual mandate. It has a single mandate.
And John, as futures deteriorate, -43 on SPX, and we're watching euro really not through the new weakness, 102.88. John, what's so important here is Elarian and Writing seem to be on the same page, that on a relative analysis, there's some real urgency here.
Well, I'm looking at the urgency of some of the data we've seen recently, John, and allow me to go through it. The ISM down to 53 from 56.1. We'll take that. But the new orders component dropping into contraction territory for the first time since May 2020. It's part of the reason we see what we're seeing on the screen right now, and allow me to go through that with you. Yields are lower for a fifth session. We're down 4 basis points on a 10-year to 284. On twos, we're down a basis point to 282. The difference between twos and 10s, a couple of basis points. Twos and fives, nothing. They're basically in line with each other. So, John, we're starting to see that inversion again, off the back of weak economic data and a Fed that's determined to carry on hiking. Can you walk me through where ultimately you think this is going in the economic data? You've pushed back against that argument for a technical recession. Just where are you seeing pockets of weakness that you think we should focus on?
Well, I think a working hypothesis I have when it comes to looking at some of those manufacturing numbers, like the ISM that you referred to, is in the midst of all of the supply chain difficulties, and those supply chains are only easing slightly. Companies may have over-ordered in order to try and get some inventory to meet the demands of their customers. And so with that comes a sort of cycle adjustment where you've over-ordered. You cut back on your orders because you start to see better improvement in your supply chains. And it's not really final demand that is the problem here. For example, in the first quarter, even if we take the GDP contraction at face value. That was coming off of an inventory adjustment from the fourth quarter. Final demand was relatively strong. It was 2% in real terms, but in nominal terms, it was much, much faster. And so my greater concern is the impact of inflation eating into real purchasing power than it is this adjustment in the manufacturing sector that we're seeing that I think is quite possibly an adjustment to over-ordering to get through supply chain difficulties.
So, John, if that is your base case, can you walk me through how that shapes your Fed call about how far they can take Fed funds?
Well, I think it's clear that the Fed has signaled they want to get a positive real or inflation-adjusted Fed funds rate. Now, for next year, the Fed has, at the end of 2023, a 3.8% Fed funds rate assessment as the median assessment of the appropriate funds rate against the backdrop of a 2.6% inflation forecast. Now, I think it's extremely unlikely that inflation, which this year is likely to run at around 5.25%, is going to slow so much. We have a real inflation psychology building in. So let's say inflation runs at 3.5% next year, which I think is more likely. Then you're looking at a Fed funds rate that may get to 4.5%. And is that a mistake? It may be a mistake in backward looking, but you may remember some while ago, and Lisa's not here, but
Thank God
Lisa
for that.
said, what if the Fed overhikes? What if they make a mistake? And I said, the mistake was already made. It was made last year when the Fed continued to ease into a rising inflation problem. Now they have to correct that problem. And they're only they don't have a model of inflation that works. They're backward looking. They want to see a compelling reduction in inflation, and it probably means they'll over tighten the funds rate. And that is when you get the recession problem, probably late 23, 2024.
Futures negative 43, Dow futures negative 340. John Riding, let's cut to the chase. John Farrow and I are going to be in Washington this week. We will speak with Adam Posen, who suggests 3% is the new 2%. Blanchard and others coming out of the great financial crisis even modeled out a 4% need on inflation to get things going. Where's the new 2% for John Riding?
The new 2% should be sub 2%. It should be
2%.
It's clear that the work on what consumers believe about inflation. They believe inflation is bad. So the Fed may have a model, and you know, Posen and others may talk about a faster inflation rate to get the economy going. The faster inflation rate is what is killing this economy to the extent we are being hurt right now. That is a real problem. And households don't like inflation because it erodes their finances, and they see down the road there being some action to be taken to rein inflation pressures in. So we had for more than 2 decades a relatively stable 2% inflation rate. Can we keep a stable 3% inflation rate? Can we keep a stable 4% inflation rate? No, history suggests not. History suggests not.
They don't talk about flexible average inflation targeting anymore, do they, John? What do you make of that?
Well, John, in September 2020, when the Fed introduced, we're going to average 2% inflation, that's going to be our target, which means we're going to overshoot inflation, they really contributed to getting inflation out of the bag. And it wasn't just the average inflation targeting, it was the backward-looking nature. We have to hit 2% inflation. We have to hit maximum employment. We have to have the prospect to be moderately above 2% for some time before they even began lifting off on rates. So no, I mean, if you talk about averaging 2%, it becomes a real problem given how high inflation has been. And so the Fed they put in escape clauses. They're going to switch back at some point just to straightforward 2% inflation targeting, but we're a long way away from that number right now.
John, we got lucky. TK, very lucky. What a clinic from John Riding of Bring Capital.
It is. Futures at negative 42. Markets here really something, John. I mean, to get to Friday is not a small matter.
Tom Keene, Matt Miller, Jonathan Ferro. Bramo with us next week. I'm going to run away.
She just sent me an email. She says they don't call it feta cheese and cream.
What do they call it?
It starts with an M.
What do they call it?
I don't know. It's a Greek
important
word.
Issues, Tom.
I can't pronounce it.
Try.
Velveeta.
Velveeta. Peter Cheer of Academy Securities joins us in the next hour on Bloomberg TV. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A 22-year-old man is being held in the deadly shooting at a 4th of July parade in Highland Park, Illinois. He was arrested following a brief police chase. Authorities say a gunman opened fire from the rooftop of a building near the parade route. 6 people were killed, dozens more were wounded. President Biden marked the 4th of July holiday by noting the U.S. has made great strides, but has also taken a few steps backwards. At a White House event, the president said Americans are worried about divisions within the country. He also described the economy as growing, but not without pain. An indicator of U.S. supply chain pressures, the Logistics Managers Index fell to the lowest level in 2 years. There was a sharp drop in transportation costs, which underscores the slowdown in the economy heading into the second half of the year. Warehouse prices, capacity, and utilization also fell. Scandinavian airline SAS has filed for bankruptcy protection to deal with its debt burden for the second time in just 2 years. The carrier has been in talks with its creditors to convert $1.9 billion of outstanding debt and hybrid notes into shares. SAS also plans to raise additional equity for about $1 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think the risks of a 2022 recession are significantly higher than I would have judged 6 or 9 weeks ago.
Lawrence Summers, a former president of Harvard, and of course, Secretary of Treasury there with David Weston, Wall Street Week, on the gaming of recession. Certainly the zeitgeist, Matt Miller, this weekend was that Lawrence Summers absolutely nailed the non-transitoriness of where we are, and the now what is open to great debate, Matt.
Yeah, absolutely. In fact, there's been a debate on transitory again, I think, because we've seen inflation rolling over in some places. If you look at the chart of fuel and food and especially metals, it's really come down, but that may be a head fake, as we know, and I think most people, the consensus now is that numbers can still go higher.
Well, we'll have to see. Right now, on China, on tariffs, Kriti Gupta. Kriti?
Well, as we talk about that inflation that may or may not be coming down, as Matt pointed out, Tom, you have to talk about what can the Biden administration actually do. More and more calls for the Biden administration to ease perhaps some of the tariffs, which brings me to my chart of the day. The amount of tariffs, or the percentage of tariffs on a global trade-weighted basis on Chinese goods in particular, from the United States to China, we're looking at a percentage of 19.3%. For our radio audience, basically, it's a story of the trade war that we've seen over the last 2-3 years going into 2018. But think about this, 19.3%. If I were to graph this on Chinese tariffs on U.S. products, it'd be about the same, about 20%. So it's that tit for tat that a lot of people are saying, is this the solution to perhaps easing some of those import prices, Tom?
That's all you got this morning?
I got to keep it short and sweet.
Got to keep it short and sweet. That was very, very short and very sweet. And also, folks, very, very nuanced here. The tariff story reported this weekend deserves a little more analysis than maybe what we're seeing. This is a joy. He has been pushed aside by news flow recently, and he has been just incredibly on at Ritholtz.com. Barry Ritholtz does Masters in Business for us, hugely successful, and also runs real money at Ritholtz Wealth Management. Barry, I absolutely love your essay on hand-wringing. Get over it. Tell me what the quality of our hand-wringing needs to be.
Well, it has to be data-based. You have to understand what makes the current circumstances so unique compared to previous scenarios. First, let's get this out of the way. 2 consecutive quarters of negative GDP is not the definition of a recession, and hasn't been since the NBER has been put into place in the post-Great Depression era. If you don't have a broad economic environment, if you're an emerging economy, well, then you could use that as a shorthand. But there have been all sorts of different changes that have been going on in the present economy that it just seems foolish to apply old discarded rules to a new scenario and say suddenly this is a recession when most of the data does not support that.
Barry, I will tell you, that's exactly what Gary Schilling told me when I asked him about this on Saturday. But the NBER doesn't tell us oftentimes that we're in a recession until after we're out of the recession, right? I mean,
right.
That's pretty useless.
Well, what are you using their declaration for? You're certainly not using it as a basis for making investment decisions. So, when we look at past recessions, we see a decrease in economic activity, primarily in employment and wages. That's the biggest driver. And go back to January through June. Yeah. Unemployment went from over 4% down to 3.6%. We have never been in a recession with declining unemployment. Now, I don't want to say it'll never happen in the future, but it makes it much more challenging. When we look at the economic data, what we're really seeing in negative GDP is not so much a decrease in economic activity as we're seeing a massive surge in inflation. Remember, GDP data is real, not nominal. And so if it tips into negative territory, it's partially due to inventory buildup, but it's also due to inflation.
Very quickly here, I want you to tell me what to do if I'm in cash. People are in cash. They're fat and happy right now in a tough market. Futures negative 45, Dow futures negative 351. What's the Ritholtzian process to get back into the market if I'm in cash?
So first, the data shows 2 out of 3 times you're better making a lump sum payment than you are doing dollar cost averaging over time. But people have a hard time emotionally making that one-time investment. So you have 2 ways to approach this. You could do this over time. Hey, I'm going to break this into 5, 20% lumps, and every other month put that much money to work. So you're buying on the way down and you're buying on the way up. Or you could do it on a percentage basis. We're down 20%. I'm putting some money into the market. Down 24%, down 28%. But market down 24%, down 28%. But pre-decide and execute it and make it automatic. Don't rely on yourself to do that, because emotionally, most people become paralyzed. And in the sea of red, it's very, very difficult to say, let me throw good money after bad. People seem to have a hard time with that.
It's a great point, Barry. And again, you know, I was watching you on surveillance last week, and you said something like, it's your mindset that's the most important variable when it comes to success in investing. And I think that's another example. Barry Ritholtz, great to have you on. I always watch or read your blog at The Big Picture, Ritholtz.com. And of course, he's a Bloomberg contributor as well. So, Tom, I guess the point is, it's always better to just jump straight in the pool rather than put your toe in and then slowly get deeper and deeper. But it's terrifying.
Yeah, it's terrifying. That's the key point. It is just everything against the human condition. Barry's math is absolutely correct. There's some great work on this we mentioned last week. Capital Guardian Trust out in Los Angeles and in others. It's wildly asymmetric. It is so hard to get back into the market, Matt. You know, you see futures negative 46, Dow futures negative 363. Do you want to go long this morning, Matt?
Well, I don't have the courage. What do you call it? You have a phrase for this. I never have the courage to be invested. So I just hand that off to someone else. But there are braver people than I, and they may be in the mood to go long, especially when we see futures down more than 1% after the drops that we've seen thus far in the first half. The question is, will the second half be even worse?
Matt Miller and Tom Keene, thrilled you're with us this morning here as we wrap up an eventful hour. Matt, I've got to take it here in the last minute to what I've avoided with John Farrell. We were very successful in avoiding Bitcoin, 19,400. Matt, Bitcoin got through a long American weekend. How did it get through without caving again?
Well, Bitcoin traditionally does much better when the market's not open. If you, for example, always buy at the market close and sell at the open, or if you only buy at the weekend and then sell before Monday starts, you do better.
All right, well, we'll have to see here. Let me look at the foreign exchange market. DXY is a huge story today. 100, 102, 104, 106, stronger U.S. dollar, and euro stunning, a 102.90 under 103. That means you need to stay with us on radio and television through this eventful Tuesday. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City this morning. Good morning, good morning. This Tuesday morning, session lows with 30 minutes until the opening bell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the downgrades piling up.
We're looking at an economy losing momentum.
Look at what's happening to the real economy.
Getting increasing calls for a recession. Economists have begun to cut their top-down economic forecasts for GDP.
We did see some pretty notable downward revisions.
Input costs have risen substantially.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
The earnings will start contracting in the second half.
If earnings crack, then that's the ingredient for potentially another leg down.
We do expect the Fed to hike rates more aggressively.
The economy is slowing, and the Fed is saying that's collateral damage.
The narrative is really going to be dictated by what happens with inflation prints and unemployment data.
Joining us now to discuss is G Squared's Victoria Green, Sam Linton-Brown of BNP Paribas. And Victoria, we start with you. You do not think we have seen the lows this year in this equity market, that June is not the low for this equity market. Can you walk me through as to why you are so strongly convinced of that?
So something has to change, and something's going to have to break for the Fed to stop. So right now we're in the don't fight the Fed, and the Fed is aggressive, the Fed is hawkish and tightening and run off their balance sheet. And that's a very difficult environment for stocks and for growth. So when you look around, in my opinion, they're going to hike and hike aggressively until something breaks. So either inflation breaks over hard, not just that it peaked out, but it's like actually coming down from the 8 to the 6 to 4. And so it is not plateaued at the 6 to 8%. And then we also need to look at what happens to the labor market. So either labor breaks or inflation breaks. Until one of those two things happen, which is the only two things the Fed actually cares about, is a full labor market and inflation. Until something there breaks, I think the Fed is aggressive, and that's a very difficult environment.
It sounds like you're on the same page as Mark Cabana over at Bank of America. This is what he had to say earlier this morning, Victoria. He said to me and the team on Bloomberg Surveillance, we think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation down. Victoria, he's looking for 4% plus on Fed funds. What are you looking for?
I mean, I think they may top out at 3.5. I think it's going to be hard for them. You know, we kind of get that break in August because nobody works in August, right? We all work in finance. We'll all be in Jackson Hole or Canada or somewhere nice and cool. So when we see September and we have the data in September, I think we'll have a little bit fuller picture. Are we peaked? Are we plateaued? What's happening to labor? I think 3.5 is about the terminal rate, maybe 4, but I think you're going to see something start to break. I think we're all very curious how June jobs came in, what the inflation numbers look like. You know, has inflation peaked? Possibly. You've seen metals, you've seen oils, and you've seen gasoline come a little bit down off their peaks. I'm not talking substantial, but hey, 5 to 480 is a little bit of a difference on gasoline prices. I will say my only caveat that may stop the Fed sooner is if liquidity dries up. That's the only reason they rescue the markets. They don't care if Tesla and Apple go down in stock price. They don't care at all. That's not their job. They're not here to help you make money in the stock market. They may care if liquidity locks up in the credit market or in money markets. And so we're watching liquidity there and spreads, but I still don't think the Fed rescues anybody, and they certainly don't care if you're losing money in the stock market.
2 points there, in fact, more than 2, but 2 I want to come back to. One's the energy story. I'll get your thoughts on the energy equities in just a moment. Then I want to come back to the credit issue as well. Sam Linter-Brown, great to have you back with us on the show, buddy. I know you're more constructive than most, and you sound more constructive than Victoria. So can you tell me why you think a lot of the cyclical concerns, the bearish cyclical concerns that you've picked up on, you think they're priced?
Thanks for having me back on, John. And before I disagree with some of the points that have been put forward, let me first agree with one, which I think is exactly as Victoria was putting forward. The Fed put's gone. And I'd go even further and to say that long put has now transitioned to a short call. So even if you're in the camp as we are, but the market already prices this type of shallow recession, and in order to have a bearish view on risk from here, you really need to be calling for a deep labour market recession. The type of ways that we like to express that more constructive view is through trade ideas that are short the right tail, things like ratio call spreads, which very much ties in with that macro theme that the market's gone from being long a Fed put to now being short a Fed call.
So Sam, where are you constructive?
Global risk assets in general, we think we could be set up for a summer rally. Look, positioning and valuation is very bearish. The catalyst for that rally, I'd agree with prior comments from Victoria as well, need to come from the idea that central banks are at peak hawkishness. And I think we're seeing some elements of that already. We know that the Fed are going to be hawkish now. We know that they're going to be aggressively trying to tighten financial conditions. And given where the short-term trajectory for inflation is going to be, rhetoric will stay hawkish. But the market's more forward-looking than that. And we've already seen that type of price dynamic in recent weeks, where we've gone from a market focused on inflationary fears to a market more focused on growth fears. Expectations for where terminal Fed funds gets to in this cycle has gone from 4.1% when I was last on the show in mid-June, down now to 3.4%. And that's when the Fed have been very hawkish and where inflation surprised to the upside. So we're in a dynamic where I think the market can price peak hawkishness well ahead of central banks taking their foot off the pedal. And that in turn can provide a catalyst for this squeeze in what's now very bearish positioning, leading to a summer risk rally.
Sam, can that catalyst develop before you've actually seen the revisions to earnings estimates?
I think it can. The earnings estimates revisions, as you say, from bottom-up perspective, have some ways to adjust to the downside. But I think the market's absolutely not priced in line with what bottom-up earnings expectations are. So if you like, the degree of PE compression that we've had this year partly reflects a derating, but it also partly reflects that E is actually lower than people expect. And I think into Q2 earnings in the US, this really sets a low bar where the market could see downward revisions from bottom-up sell side for earnings, and yet the market could actually rally. And that would be, for example, the opposite of what we saw in Q1, especially in Europe, where the market interpreted the information as negative. Euro stock sold off, and yet all we saw from bottom-up analysts was upward revisions.
Futures right now down 1.3% on the S&P, about 15 minutes to go, 25 minutes to go until the opening bell. Busy week of data pushing ahead to payrolls Friday, following a weak ISM print on last Friday, with the new orders component coming in contractionary territory. That is not good news. Mike McKee has more. Hey, Mike.
John, the recession story seems to flow this way. Consumers are concerned about inflation, so consumer confidence is way down and they're going to stop spending. But take a look at what's happening right now. Consumer confidence is way down, but Americans are not stopping spending. The data we got last week from the PCE numbers, this is the inflation-adjusted numbers, and there is a bit of a drop, but not much, and there's this huge gap between consumer sentiment and consumer spending. And I put the red line on there, the arrow, to show that consumer spending has basically maintained throughout the pandemic and kept going from on the same track as it's been on. So is the consumer going to roll over or not? That's the biggest question out there. Right now, the market's talking a lot about recession and talking about the Fed breaking things and pricing for something different. We have now moved off of a 75 basis point move in September to a 50 basis point move. If the market can move that fast, what about the Fed? The Fed could change its mind between now and the end of September. This is the week we got to worry about, though, and here's what you got to watch to see if that move in the Fed funds rate continues. Initial jobless claims, that's going to be your canary in the coal mine. Everybody agrees. If we start to see them significantly rise, then the June payrolls, of course. Look at unemployment and wages. We don't have recessions unless we have a big rise in unemployment. No sign of that yet. And then the St. Louis boys, Chris Waller, Fed governor, and Jim Bullard, the St. Louis Fed president, they've pretty much been aligned here in saying what they think is going to happen. And they were the ones who really predicted inflation coming and the Fed would have to be more aggressive. So let's see what they're thinking. They both speak on Thursday.
Mike, before you go, I've had a ton of messages over the last week or so about the Atlanta Now GDP, nowcast, forecast, whatever you call it these days. Your thoughts on it? Deeply negative now, implying that technical recession many people are looking for. Can you give me your thoughts on how useful that particular data point is?
Well, it's an input. It's a model like so many others on Wall Street. And a lot of people on Wall Street have much different numbers than the Atlanta Fed. And the Atlanta Fed incorporates numbers as they come in, then has to extrapolate some. So really, it's working with data that just goes through May. We haven't seen the June data yet, and it could easily change. So at this point, it's probably not, put it this way, it's not a prediction. It's what would happen if the quarter had already ended and we knew what the numbers were. So I would not worry about that yet.
Some people worrying about it already. Mike McKee, thank you, buddy, as always. Credit Suisse cut their price target on the S&P to 4,300 from 49. Here's the quote from them. We reiterate our 22-23 EPS estimates. Our target is being adjusted lower to reflect the higher cost of capital on valuations, not recessionary concerns. Victoria, that's Credit Suisse. In your mind, what gets us to 4,300 from where we are right now?
The job market breaking and the Fed slipping over. The moment the Fed flips from hawkish to dovish, that would get us there. So if something breaks over the summer, then absolutely we could see that rally out. I just don't think the data is going to be that bad. You know, you looked around and we had 11 million job openings still. We're having this dislocation between people looking for jobs and the jobs that are available. I still think it's a really tough and tight job market. I do tend to think, you know, this would be a more mild recession. It's not going to be an 08 or a 32. It's something that we can bounce back from quickly. The one thing I caution against, you're not bringing EPS down. I mean, we're all sitting here quaking in our boots about Q2 numbers that are about to come out, and I think it's going to be a little bit ugly under the hood. You look back at the pressures in Q2, and I think margins are going to be compressed. I think EPS could come down. You know, there's that great factoid, you know, Wall Street analysts are really reluctant to cut EPS forecasts. It's a very fast way to get fired. If you cut a forecast, then you're wrong. And so in 08, I think like we were anticipating a 15% EPS growth, even though the economy was already rolling over. So you got to understand a reasonably valued market depends a lot on the E, as my co-host suggested. And I think the E's are going to be under a lot of pressure right now just because of what happened in Q2. And so we want to look at, and we're seeing warning and guidance from CEOs. I haven't, and I can't quite recall right now, any CEO right now that's like, hey, everything's great. We're going to do wonderful in the second half of this year. And you got to take that and take that with a grain of salt and realize if your leadership is warning you that things could be rocky and you're seeing people say, hey, this might get a little worse, especially the banks and the financials, I think you need to listen to them.
Victoria, just a final question. Are you saying, and I think you're implying this, but I wanted to clarify, that the forward-looking side of things on the E is distorted by career risk?
Yeah, I think there's a lot of risk there, and I think it is hard for a lot of people to downgrade earnings because, you know, this is a short time period. We always talk about investing in a long time horizon. So forecasting earnings in an uncertain environment as consumers are changing the behavior, you know, Target's the poster child for that problem, right? They all of a sudden had this consumer spending shift. And as you guys pointed out, consumer spending is strong, but what they're spending on has changed dramatically. And so I think you're going to see potential pressures. You even saw Tesla missed on their deliveries and their delivery numbers fell in Q2. And so you have to look around and wonder, how did anybody really grow their margins in an inflationary tight labor market in Q2? I'm sure some did. Absolutely, there are companies that are going to weather this well, but earnings certainly could come under a lot of pressure.
Victoria, Sam, sticking with us. Your equity market breaking down by 1.3% on the S&P, going into the open about 20 minutes away. Yields lower again for a fifth session. We're down 7 basis points on 10s to 280. 2s 10s just a couple of basis points. 2s 5s basically bang in line with each other, with some movers going into the open. Here's Taylor.
John, we'll continue sort of that risk-off mood that you highlighted. Start here with Tesla. Of course, we got the report on Friday that some of those deliveries were a little bit lighter than the street had expected. But I will caveat that with Dan Ives coming out with a note saying that a lot of this was well known. We knew about the COVID lockdowns. We knew about China's shutdown. April and May were light, but June was one of the stronger quarters. So again, with this stock, how much with Tesla are we thinking about backward lookings versus forward and some of that reopening trade and maybe sort of that reopening of China? When you think about the demand side of things, though, NVIDIA certainly is one of those. Coming off of course, the Micron sort of forecast, the weaker than expected forecast that we had last week. How much of this is a demand story when we think about the chip space that is weighing on the sector? Metals as well, the third sort of line there on your screen. Our Bloomberg Commodity Metals Index down for a 6th straight week after 7 weeks of losses back in April and May. If there is one bright spot, though, it is Cowen TD Bank, of course. A report late Friday saying that they're looking at maybe a takeout or a buyout here of Cowen, that U.S. brokerage. Interesting comments here from the street, John. Piper Sandler coming out and saying that it could be attractive to the TD's ROE. It could be accretive there already. JMP Securities saying that based on revenue alone, that price could actually be in the $50 to $60 range. So the street rat saying it's reasonable at the right price, John.
Taylor, awesome. As always, Taylor Riggs with us through the opening bow. Coming up, top US and Chinese officials discussing economic policy.
Our economy is growing, but not without pain. Liberty is under assault both here and abroad.
Is the United States setting the stage to roll back tariffs on China? That conversation up next.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Wednesday, July 6th, right here on Bloomberg.
Our economy is growing, but not without pain. Liberty is under assault both here and abroad. In recent days, there's been reason to think that this country is moving backward. I want you to know we're going to get through all of this. From the deepest depths of our worst crises, we've always risen to our higher heights. We've always come out better than we went in.
The President of the United States, the US and China holding talks amid reports that the White House is considering easing tariffs. The Treasury Department writing the following. During the candid conversation, they discussed macroeconomic and financial developments, the global economic outlook, amid rising commodity prices and food security challenges. For more, let's get to AMH from the White House. Anne-Marie, let's start there. The prospect of removing tariffs on Chinese goods.
Well, John, we should be clear. The administration has been debating this for literally months. Now, potentially, we could get an announcement. The president himself said he would have an announcement soon last month, as well as also highlighting that he'll potentially be speaking to his counterpart Xi Jinping. But now you are seeing a number of meetings fall into place. We had Jake Sullivan recently meeting his counterpart. We have now Secretary Yellen on the phone with China's vice premier. And just in the last hour, we learned that Secretary Blinken will also be meeting the Chinese foreign minister on his upcoming trip to Indonesia. The issue the administration has is that it is divided. There are some, like Secretary Yellen last month, saying that they want to reconfigure some of these Trump-era tariffs. Will be on everyday, commonplace merchandise. And then you have others, like Ambassador Tai, saying that these levies are a force of leverage and that what they would take away in terms of inflation will be marginal. Barclay says it's about 0.3 of a percentage point. So the president, Jonathan, who will make the ultimate decision, needs to decide at this moment with midterm elections in November, does he want to be seen as potentially soft on China, which what Republicans will come out and say if he lifts those tariffs, or if he lifts them, does he want to use that as a spin to say he is doing everything possible to ease inflation, even though it's potentially going to be very marginal?
That is a really, really difficult needle to thread. Yeah. Anne-Marie from the White House, AMH, thank you, and good to have you back stateside. Looking back to Europe, where Anne-Marie's just come from, euro-dollar 102.77 and negative 1.4%. Sam Linton-Brown, we've got to talk about the single currency breaking down here. You're constructive on parts of this market. Can you be constructive on that?
Can't today. It's a very significant break. We've gone to near 20-year lows. And importantly, this is quite an FX idiosyncratic move. So while it's directionally consistent with what we've had in other asset classes today, underperformance of European risk assets, higher natural gas prices, a retracement in core yields in Europe, the FX move in magnitude is much bigger. So this likely reflects some large idiosyncratic flow hitting the market. It's taken us through that key level. And in terms of fading it in the very near term, independent of what your medium-term view is, I think that would be unwise. Now, for me, the question is, well, if you want to go with positive dollar momentum, given the magnitude and the significance of today's technical break, where are the attractive ways to be positioned? We actually think euro-dollar is not the most appealing. This is for a number of reasons, but primarily long-term valuations likely to result in some buyers at these levels that fade any decline. So I'd focus on two other currency crosses and pairs. The first is Euro-Swiss. I think this can break down materially. We've already taken out parity today, and we think it can head down to 96. Aside from the Eurozone growth risks that the trade captures, it also puts you on the right side of what, in our view, is a very material pivot, very material shift, I should even say, from the S&P. Second trade is cable. We've broken through 120. We think that can absolutely extend. Our view can be that you can have euro-dollar stable at these levels, but euro-sterling rising to 90. So for a dollar momentum trade, we think cable is more appealing than euro-dollar.
Euro-Swissie at 96, that's brutal. Right now, what we're seeing on the single currency is brutal, and the relationship between what's happening with Europe and energy is pretty clear for all. Victoria Green, there's a question that a lot of people have got on the energy side of things. I know you've been constructive. I know you've been thinking about buying this weakness. Devon's 30% off the June highs. Can you walk me through, just help me understand, how in a world of decelerating growth, potentially recession, that the energy trade will continue to work?
And we have kind of pulled that back a little bit on our bullish call. Absolutely. We took some profits end of June. We are still overweight versus the benchmark in the energy sector. And you saw a little bit some of the questioning of where crude's going to end up. You got JP Morgan with 380 and Citi with 65, right? We have this like huge bifurcation of where crude may run. And there's a lot of factors. Number one is, what is Russia going to do? Are they going to, the cap is not going to sit well with them. There's concerns if the Nord Stream shuts down in Germany, they're never getting it back open. And you're seeing in a little bit, I think that ties in with the currency play. Energy producers, and we're very strong. Our economy, we're in a rising rate environment, and we produce energy. Energy consumers, your yen, your Japan, and your Europe, you're seeing their currencies come under some pressure, and there's definitely a potential of an energy crisis in Europe, depending on how all this plays out. So if you're looking through your scenarios, we always go with what's the highest probability scenario, which I know it might be asking a little much, but I tend to think we're going to have rational actors. So we're not going to see crude to 380. We also don't see a severe recession. The crude 65 is also extreme. But I generally still like the energy space. Again, we did lighten up the positioning a little bit, took some of the profits, because in investing, it's never a profit till you actually sell it, right? So we did want to lock in some of that. But we see inflation and crude staying high because of geopolitical risk. Now, that's a wild card with Russia, what Saudi Arabia does. You know, if we're talking to China, are we going to talk to Iran?
Very good point. Victoria Green, Sam Linton-Brown, to the two of you, thank you. Euro dollar, session lows right now, 102.68. Up next, the morning calls, and later, Peter Cheer of Academy.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Equities heading lower. Here are your morning calls. First up, Citi downgrading Sony to neutral, highlighting macroeconomic risk and a potential drop in valuations. Piper Sandler lowering its price target on Netflix to 210, citing subdued user growth. And finally, JP Morgan lowering its price target on Tesla, 385, expecting production to take a hit. Coming up, the slowdown story weighing on equities. Academy's Peter Cheer turning bearish. He joins us next with your opening bound just around the corner, and futures down 50. We're negative 1.3%.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Equities negative here. Good morning to you. We're down 1.3% on the S&P 500. On the Nasdaq, we're down by a similar amount. We're down by 1.4 on the Russell. The small caps even lower by 1.65%. That's the equity picture. It's a negative one. It's session lows going into the opening bow from New York City this morning. Good morning. There is your opening bow. Let's talk about things cross-asset. Let's talk about this bond market. 5 straight days of yields lower. We're down 281.27 on a 10-year this morning. The difference between 2s and 10s, just a single basis point. The euro is where a ton of pain is. 102.65. You've got to take the chart back to 2002 to see these kinds of levels. 102.67 and negative 1.5%. WTI crude 104.25. We're negative 3.9%. That is a turnaround in the last couple of hours or so. But the bond market for me is the main event outside of foreign exchange. In the bond market, we're seeing the spread between 2s and 10s get narrower, the curve get flatter, and we're seeing the bond market respond to weak economic data. Yields lower for 5 straight sessions. On 10s at 281, on 2s at 280, and we'll have a big conversation about what's happening in the credit market outside of Treasuries a little bit later this morning with Peter Chu of Academy, and what that will or will not mean for this Federal Reserve. At the open, about a minute in, let's get you some movers. We can do that this morning with Katie Greifeld.
It's another ugly day for tech already, and particularly for the chip stocks. Micron was the big loser on Friday. Today, it's AMD falling over 2% from the opening bell. JP Morgan also under pressure. John, I know you're watching that yield curve. Like you said, the 2s-10 spread just about 1 basis point away from inversion. That's bad news for the banks, bad news for JP Morgan, down over 3%. Travel stocks, no picnic either. You can see Carnival down 5.5% after just a terrible week last week, falling again today, along with just about everything else in the sector. Cowen, though, it's your rare bright spot, up over 16% after that late Friday news that TD reportedly exploring a takeover. Analysts this morning broadly positive on that potential merger in commentary. And John, I do want to quickly hit on Ford because this headline crossed at 9:15 that Ford U.S. sales were up 31.5% year over year in June. And we know that Ford is betting big on EV pickups in particular. GM and Tesla not expected to compete in that space before 2023. That gives Ford a little bit of time to grab a foothold there. Currently, EVs make up just 2% of Ford's sales, but John, that's expected to be 40% of sales by 2030.
That stock is down about 4%. Katie, thank you. Good to see you, that's for sure. Euro dollar, not good to see this. That chart just breaking down even more, down 1.5%, 102.63. Nomura and Jordan Rochester earlier this morning publishing this. Today's move lower in euro dollar, thanks to Norway's gas strikes, new highs in German electricity prices, is just a warning as to what might materialize. Their numbers they're looking for now, 98 on euro dollar, 98 and maybe even 95. Right now, 102.66, and numbers we haven't seen since 2002. That's the FX story. Looking ahead to earnings just next week, July 14th, you'll hear from JP Morgan. Before that, here's a data point for you. CPI next week on July 13th. Before we get there, we need to deal with payrolls this Friday. A lot to think about, Taylor Riggs, a lot to think about through the next couple of weeks.
And how much does that fold into the dollar strength story that you just mentioned, right? Sort of the defensive nature of this rally. And that really sort of is highlighted here when we take a look at cyclicals versus defensive and how sort of classic this chart is. With cyclicals, you're still down 26% when you think about where we are year to date, just over 6 months into the year. The defensives only off maybe about 4% or so. Earlier coming into this morning, that number was less than 3%. So it's an underperformer, but on a relative basis is still outperformer, if you will, when you think about the defensiveness of this. The next chart is a classic Dan Curtis chart. We're doing standard deviations, John, at 9:33 in the morning. On a standard deviation in terms of upside surprise, the household sector, the consumer, actually better than expected. Down at the bottom, housing, worse than expected when you think about where we are relative to consensus coming into this year. And if you change up the board again, you really see this. How much of this has been a rate story? Of course, today yields lower on a risk-off trade, but year to date, we're looking at mortgage rates rising, new home sales rolling over. But how much of this is exactly what the Federal Reserve wants to see in terms of making maybe the consumer feel less likely to buy, slowing down the overheated housing market?
Taylor Riggs, thank you. We'll catch up with Taylor again in just a moment. And Taylor hit the nail on the head. This is what Mike Schumacher of Wells Fargo said last week. This is a feature, not a bug for this Federal Reserve. This is the goal, the objective. At what point, where is the tipping point in this market where it becomes a bug and not a feature? Seemingly not now, with high yield credit spreads at around about 580. Is it 600, 650? Is it about the price? Is it about supply? Is it about liquidity? I guess if we carry on pushing it, we'll find out. About 4 or 5 minutes into the session, we're negative 1.7% on the S&P. Every single industry group on my screen right now is negative. Energy's down 3 percentage points. Materials down 3%. Katie did a great job of bringing up JP Morgan. Financials down by more than 2%. Staples down 0.4. The overall benchmark, the S&P, down 1.7. Taylor mentioned some of the house builders. The home builders year to date on the S&P down 33%. And Peter Cheer of Academy is sounding the alarm on housing. He says the following: I'm told that housing formation supports home prices. Scarcity remains an issue. All cash buyers make up more of the market, and all sorts of other reasons why housing prices cannot go down. But I see the combination of rapid price acceleration and the gap higher in financing costs as a toxic mix. Pete, I'm pleased to say, joined us right now. So Pete, let's start there. How big a problem do you see?
I see actually a very big problem. I think we really have to start thinking about the wealth effect, right? We're not hearing much talk about wealth effect, but if you look at this year, stocks have been horrible, bonds have been horrible, crypto's been horrible, and I think we've seen a turn in housing. And I just think that is going to accelerate the problems, and that we are so leveraged as a financial system to rates that people are underestimating this mix of, how each thing interacts with each other. And I expect a really horrible summer in terms of the data deteriorating far faster than people expect.
Let's put some numbers on that horrible data that you forecast, Pete. You know the consensus now, if we get a recession, it'll be short, it'll be shallow. Are you pushing back against that?
Yes, I think it'll be deeper and longer. Again, until the Fed really switches and gets off fighting inflation at all costs, I think they're missing all these little hints that there's problems in the economy, whether it's inventory builds, whether it's housing starting to slow down, and then the wealth destruction that you've seen in crypto and in terms of disruptive stocks is really twofold. One, it's hit the individuals who own those companies, were part of those companies, who were getting paid by those companies. But I think the next wave is the spending that was done by those companies. When people didn't care about cash flow positive, right? If you could just spend and it was all about potential future growth, there was a lot of excess spending being done by those companies. I think that's going to hit very quickly too. So I think we're in for a double whammy, and I keep having visions of Wile E. Coyote, with the Roadrunner just hitting a wall.
Pete, I wish it was that entertaining. Unfortunately, the picture you're painting is a pretty dreadful one and might be scary for some people. Typically, when we talk about the potential depth of a recession, we'd look for excess. You're speaking to that. We'd look for the breadth of that excess, and we'd be talking about leverage. Where is the leverage? How big is that leverage? Pete, that's why some people are pushing back and saying it'll be short, it'll be shallow, because this time around, it's hard to find the excess on household balance sheets and corporate balance sheets. Do you push back against those 2 points too?
I do. I think we're not going to go into a great financial crisis. I think people's balance sheets are in much better shape. but we've become so used to this high level of spending, and we still haven't been able to separate how much of the spending that occurred was due to, government stimulus, right? We had so much government stimulus. You also have this issue that, okay, bank accounts are very flush, but a lot of people didn't pay their rent or their mortgage payments or their student loans. So I think there's a real balance, and I think things are more precarious. And if you dig deeper into the system, I think there's a lot of imbalances that are starting to come out, and we'll see that accelerate. Again, I'll go back to crypto, right? A few weeks ago, it was what price it is. Now it's about which companies are going out of business. Can you get your money out of accounts, right? So this narrative has changed, and it's changing very quickly, and I think we're just going to see that across the board.
Pete, why do you think that pocket of excess in crypto is sufficient enough to make a call that this could cause big problems in this economy?
And I just highlight this as maybe as the tip of the iceberg, but this time around, right, crypto's dropped 60 some odd %, but to me, you've probably lost about $2 trillion. And that was relatively new wealth that was created. It was almost found money. So I think people were very happy to spend that money. That money was also, spread around various tech companies. Those tech companies have gone down. The people who had stock options in those tech companies, whether they were 5 million, 10 million, expecting to be 15, 20, 30 million, right? People were buying houses in cash because they didn't care. And now with this kind of across the board wealth destruction, people are turning about A, how do I preserve my wealth? B, will I still have my job? And that's a very different narrative. And I think you're just seeing spending change very dramatically, very quickly. And it's because now people have to go back and think about wealth preservation. I think that's for individuals and companies.
Pete, I wonder when this puts the brakes on the Fed's goals and how far they can take Fed funds. Take a listen to what Mark Cabana of Bank of America said this morning.
We think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation lower and for the Fed to feel like they can declare victory in that backdrop.
Pete, he made two big points here. One, we're only halfway through the tightening of financial conditions. And two, he thinks the economy is resilient enough that the Fed will have to take rates through 4%. Out of those 2 points, what do you agree with the most?
I guess on the economy, but I think we're not going to get anywhere close to 4% on hikes. I think long before November, the politicians are going to start realizing that a slower economy is far worse than any inflation pressure. I think the narrative out of DC is going to change. I think there's going to be political pressure, and everyone's going to talk about, wow, who cares about inflation if we start losing jobs, if spending starts going down, if GDP is decreasing, right? All you have to do is go back to Bush Sr. to see how important the economy is to get reelected. And I think that's going to be the narrative that shifts. And I think it's going to shift very rapidly. And they are going to regret their hikes, as early as August.
Is that the point that you want to buy this weakness? We're down 1.8% on the NASDAQ, down 1.9% on the S&P. You're seeing that classic race to the US dollar with euro dollar at 102.60. Is that the point at which you think some of this turns around, Pete?
Yeah, I would like to see maybe another 5 to 10% pullback. I'd really like to see some of these, high-flying ETFs like TQQQ, which is a triple leveraged QQQ, really see outflows. That to me would be the signal, okay, people have kind of given up and now is the time to step in and buy. I watch Eurodollar to maybe bottom. I like some of the calls that you were talking about earlier, whether it's 98, 95. And I think what's really happening is people are realizing Europe is in deep trouble. Europe is headed towards a recession. Once that gets priced in, then I think people will start realizing, wow, how far behind is the U.S.? And that's when we start seeing a big reversal. That hopefully is kind of the washout that we need in U.S. equities to become a real buyer. Or we need some signal from the Fed that they are going to ease off on their both quantitative tightening and or rate hikes.
So, Pete, I just wonder, is it too early to see it in this earnings season if you're expecting some of this to really climax later in the summer?
I think it's probably too early to see in this earnings season, though I think you're going to start hearing a lot more about warnings, and you're going to hear about spending cuts. And it's the spending cuts that I think will be as important to triggering a wave of selling as it is going to be the earnings warnings.
Peter Schiff of Economy is going to be sticking with us. Some big calls here. He's looking for more downside in this equity market, maybe another 10%. I think if you are looking to buy this market, it makes sense for Pete to say, I want to see that before I buy. But ultimately, he's looking for some real economic weakness as a catalyst for some of that extra downside. Right now, we're down 1.9% on the S&P. On the NASDAQ, we're down 1.7%. Talked a lot about this move in euro dollar. It's a real break, a break of numbers we haven't seen in a long, long time. To see a sub 103, you've got to go back to 2002, 102.67 and down by 1.5%. Heavily weighted, of course, the single currency on the dollar index. DXY, 106.50, 106.50, and still the commodity market, looking at numbers A little something like this right now. Brent and WTI north of 100, but only just as we break down there too, by 5.7% on Brent to 107, on WTI to 103, down about 5 percentage points on the day. Coming up, conflicting calls on crude emerging on Wall Street.
I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We still see Russia acting as a rational player in the market, both for oil and for gas. It doesn't mean that energy doesn't get weaponized. I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment. Nobody's actually able to raise production very much.
When it comes to forecasts, predicting crude prices is probably one of the difficult jobs out there, the most difficult jobs out there on Wall Street. The strategists right now all over the place. Citi on the one side, warning crude could collapse to 65 a barrel by the end of this year. JP Morgan came out with this scenario, seeing the potential, I stress potential, for prices to rise to an all-time high of 380 if Russia cuts output. Taylor Riggs has more. Hey, Taylor.
And that is the conundrum, John. I really wanted to focus on the downside call from Citigroup looking at 65. If there is a recession, it actually, and now maybe over $100 a barrel seems pretty far off, but you go out a few months, that is the December contract all the way back down now to just 91, 92 a barrel. So maybe not that far out when you're thinking if there is a recession by the end of the year. That is the call for 65 now, just about 92. A lot of this, of course, does bank on if there is a recession. We really have to do some historical analysis here. When you think about 08 and 09 and the global financial crisis, we went from 90 to 70. You bottomed out at 35. Don't get me started about 2020 with a huge demand issue. And then we saw some negative prices briefly there, but again, sort of settling out in that $30 range before really coming up here into sort of beginning of this year into back to the triple digits. I think what is so interesting when you think about where we are at about an average in the second quarter at 108 this year, price per gallon is $5. And John, this is the conundrum. Are higher prices the cure for higher prices? Do the consumers start to push back? How much of that is baked into this call as well?
Right now, Taylor, there are some big problems off the back of some of this in Europe, not just crude, but gas too. Taylor Riggs, thank you. And a big move in this German bond market, down 16, 17 basis points at the front end to 43 on 10s right now, down 13 to about 120. Do you remember when we got close to 180? It wasn't that long ago. Right now, 120 on a German 10-year. The economy minister out of Germany had this to say after putting together a bailout package for struggling energy companies. We will do everything to keep up the basic supply in the coming winter and to keep the energy markets running as long as possible. Matt, and it's good to have you back, mate, as always. Matt Miller, they are not the things you want to say as a politician, are they?
No, and especially not as a green politician, right? You don't want to encourage the use of fossil fuels, which Robert Habeck may have to do in order to get anything through politically. Now, the plan right now is to pass on higher costs. That should be a way to deter usage, right? But also this $9 billion bailout of Uniper, spending money at a time when the German government really doesn't want to have to do that. So we've got this issue at the same time as the euro comes down to below $1.03, right? We saw $1.02 this morning, the lowest level since 2002, which was really the very beginning of the usage of the euro in public by consumers. And at the same time, you've got a trade deficit for the first time since 1991. That's basically when the wall came down, like a year after the wall came down, was the last time you had a trade deficit, because Germany typically builds and sells many more things than they buy. The problem is they sold 0.5% fewer things in the last month than they did in the same month the year before, and they bought 2.7% more things than they did last month in the same month a year ago. So they're seeing a higher trade deficit, they're importing inflation, and they have this lower currency that should theoretically allow them to sell more stuff, but they just can't do it, especially without chips to get their all-important cars on the lot and out the door.
Matt, love this morning. Thanks for the extra shift on Bloomberg Surveillance. Thank you, mate. Matt Miller there, breaking things down out of Germany. Peter Cheer, I'm just going to keep it straight and open for you. What's developing in Europe right now, Pete, from your perspective? How bad is this going to be?
I think it's going to be very bad. I think you're seeing this energy crisis play out. I think you have a slowing economy. You have this displacement of people. You've got food crisis potentially there. So I think Europe's going to be very bad. I think you're seeing the U.S. going to follow suit. So again, it keeps coming back to me that there's this recession. And I do like the one other point someone made, I think, was we're looking at energy and where we stand in inflation. To me, there's three threads to pull. One is recession. What does that do to energy prices? What's that doing? Two is, have we really shifted to this kind of global commodity war? And I think that really is a global commodity war. I know we've discussed it before, where I think what you have is China and these autocratic commodity-rich nations aligning to secure commodities. And that's left us out a little bit in the proverbial cold. And we're going to have to figure out what to do about that. And the third part of that thread, or the third thread really, is what are we going to do about energy domestically? I believe that we have to build out sustainable energy faster than we're doing. I also believe that we have to spend a lot of money and reinvest significantly in traditional energy. I really thought we would see some of this the day after Russia invaded Ukraine. And here we are, months and months later, and we're still not doing much. If anything, we're still causing friction between the energy companies and our need for production. I need to see a plan. I want to see DC come up with something that puts us on a 5 to 10 year plan towards energy independence. And then I can get more comfortable.
Pete, final one from me. High yield spreads breaking out pretty much all of last week, pushing 600 basis points. in and around 580. You've talked to me about that tipping point in this economy. Before we get there, you'd imagine this market starts to pick up on it. How much wider do you think those spreads are going to go?
No, I think they can go a little bit wider. I really do think, though, this time it's going to be led much more by equities. So I think credit's going to outperform equities pretty significantly. Though for high yield, I'm always watching the Russell 2000. That's the correlation I look for there. On investment grade, I watch versus the S&P 500. I don't see the leverage in the system. I think you're going to see a little bit of weakness. You're seeing leverage loans. In fact, if anything, I'd probably be a little bit more concerned about leverage loans than the high yield bond market, because I think the high yield bond market over the last 10 years has matured. It's more, public in terms of the companies there, the information available, and a lot of the deals that might not have got done in the past kind of found their way into the loan market. So that's probably where I'd keep looking for that canary in the coal mine to see if you start seeing a breakout there.
Pete, thank you, sir. As always, Peter Cheer there of Academy. Just looking at this market at the moment, still breaking down. About 23 minutes into the session, we're down almost 2% on the S&P. We're down 1.6% on the Nasdaq. Looking at the bond market right now with a strong bid in Germany, down by more than 10 basis points right the way through the curve. 2s out to 10s. 10s right now in the US down 6 basis points. The 2s are down 2, and the difference between 2s and 10s is fewer than 1 basis point right now. 0.7 basis points. A lot to talk about, a lot to look ahead to. Your trading diary up next.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Five minutes into the session, stateside after the long weekend. Welcome back. We're down by 2% on the S&P 500. On the Nasdaq, we're down by about 1.5. That's the equity picture. The bond market story. 5 straight days of Treasury gains, yields lower, down 6 basis points, 281.63. Risk aversion, a story out there. That's the headline. That's the price action. Here's your trading diary data in just a moment. Durable goods, factory orders, top of the hour. We'll get Fed minutes on Wednesday. The ISM, services, some PMIs, jolts, job openings, take your pick. Tons of data. Initial jobless claims, another round coming up on Thursday. Then the big one this Friday. The main event, it is payrolls Friday. And the median estimate so far is 273 in the Bloomberg survey on my screen right now. 390, the previous number. From New York, this was The Open. This is Bloomberg TV.
Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of Grant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide.